Yes, so hi everyone and a warm welcome to our channel. I hope you are doing well. Studies and preparations are going on. CA Final IDT HOTS, a very critical resource for your IDT preparation. We have the feedback. We know how much this is going to impact and level up your IDT preparation. So the original video we had already uploaded a couple of days back, and the auto dubbing option was not enabled. The reason behind that was I was going to upload a new video in 100% English delivery, especially for you guys. So that is the reason I didn't give the dubbing option. So the interlinking parts we are uploading, that is available in the dubbing. The dubbing option is enabled there. But this is something I wanted to give you a fresh video in proper 100% English delivery, right? So this one is only for you. We'll be starting with the discussion. You already know what this video is. We are going to be covering 200 plus pointers. These are mistake areas, these are summaries, these are short interlinked points that we will discuss, and this will basically help you to avoid those mistakes in the paper, right? So doesn't matter from whom you have studied. You might have covered some, the practice batch from me or your regular classes from someone else. It's absolutely okay. We are going to be referring to our material, and this PDF is available on our main Telegram channel. The Google Drive link is there. In that you can find this. The Telegram channel is in the description of this particular video. Okay. So before going forward, if you like after the lecture, I'm not asking you to do it right now, but after the lecture, if you feel that there was a value addition, ensure that you're liking and sharing your feedback, so that it helps me to reach more students from south, right? Because we do bring resources for you guys as well, and this time we took a practice batch also in 100% English. Okay, so without any further ado, let's start. 200 plus pointers HOTS for CA final indirect tax. Yes, so this is for Jan'26. Let's start. First, we will be going through the GST portion, and then we'll do the customs part. Let's start supply chapter. First, actionable claims are goods, not services. Just a point to be noted. And as you know, in our GST, specified actionable claims stay in the scope of GST, but balance ones get outside. They are excluded from the definition of supply. For example, the insurance claims, right? So the actionable claims are specifically covered in the definition of goods. Next, Delhi Development Authority was clarified to be not a local authority. Now, obviously, they are not going to test this as it is. Maybe they will be testing some form of an exemption with respect to the local authority, and there you need to make a note of it that DDA is not a local authority. So any exemption available with respect to local authority, DDA, you will not be giving the exemption. A Limited is a short example that if A Limited holds 30% in B Limited, this will not be a case of related person. Now, somehow I have seen that students just learn that 25%, the point in the related person explanation to section number 15, that sir, we have learned 25% voting. But guys, that 25% voting is when one person is holding in two companies. So A company is, let's say, holding in B company 26%, and in C company, let's say 30%. So B and C are related to each other. But if one is holding in another, we need to have the definition of control. We need to see the word control. Control, although it is not defined in the GST law, but in general meaning, in the general understanding, we assume it as more than 50%. So here it is not more than 50%, it is 30%. And here 25% thing is not going to apply because one person is not holding in two. Here one person is holding, one company is holding in another company. So this will not be a case of related person. And related person and not a related person, this is one of the conditions that we see in section number 15, that is the valuation of supply. Yes. Next, cost petroleum and profit petroleum. The ultimate conclusion is same, that there will be no GST, but the path to the conclusion is separate, is different. Cost petroleum is not a consideration itself. It is not something the person does for any, the government or any third party. It is for his purpose only, and this is merely a cost recovery. Profit petroleum complies with all the parameters of a supply. There is a supplier, government is a supplier, there is a recipient, the oil exploration contractor, and the supply is the assignment of the license or the right to explore the oil, right? So all the parameters are complied of supply, and the consideration is this share of the profit, which is known as profit petroleum, but ultimately it will be exempt through the exemption chapter, right? So the ultimate path, ultimate conclusion is same, but the path and the reasoning is different. So ensure that you are writing the correct reasoning in your notes. Next, derivative, it can be asked as one of the transactions in your 14 marker question. If there is a delivery of the underlying commodity, you consider it as a supply of goods and you will be charging the GST. If there is a net settlement, it will retain the nature of a security, and security means derivative, and derivative is a form of security as covered in the definition of the security, hence no GST. Okay, because securities are neither goods nor services. Next, As you know, schedule number one deals with the deemed supply. Under that, there is a paragraph number 3 which deals with the principal and agent. But just point to be noted, only goods are dealt there. In paragraph number 3, we only and only talk about goods, not services. So short reasonable conclusion we can draw that when there is a case of principal and agent, and it is a case of service, we do require consideration to make it a supply. Because if there is no consideration in case of service, and unless it is a sole agent, because if it is a sole agent, we can go under paragraph number 2, schedule number 1. But unless it is a sole agent, if it is not a sole agent, it's a normal agent, and it is a case of service, we require consideration. Because paragraph number 3 applies only and only with respect to goods, not with respect to services. Now, a short example to deal with the concept of the distinct person. Let's say there is a factory in Lucknow, UP, and there is a showroom in Kanpur that is also in UP, and there is a single registration obtained in UP. This is not a case of distinct person as per section 25. See, there are two aspects, 25.4 and 25.5. 25.4, all are registered. One state, more than one state, I don't care. 25.5, one is registered, now other is in other state. Obviously, it would be unregistered, because if it is registered, then we can apply 25.4. So in 25.5, more than one state is involved, and then the term we use in 25.5 is the establishment of distinct person, right? So in this case, there is one state UP, and we have not taken separate registration, we have taken single registration. So neither 25.4 applies nor 25.5 applies. This is not a case of distinct person, and distinct person use is done in the distinct person use is done in section number 25, in your schedule number 1. Basically, distinct person 25 is used in schedule number 1, paragraph number 2, right? Related person and distinct person. Just a point to be noted, if the term used is APOB, additional place of business, this is not a distinct person. This is an additional address in the same registration. Is it clear? So this is not a case of distinct person. Next, a short summary diagram with respect to import of service, and you need to have a structured thinking, otherwise it will create a problem. Pay attention. Import of service, if there is a consideration, please don't think about schedule number 1, paragraph number 4. Don't think about it, because there is a consideration. Here you will just think about 7.1b. What does 7.1b say? That if you are importing services, right, and there is a consideration involved, you don't see the business test. It can be business, it can be other than business, it will be a supply. Now please make a note of it, that once it is a supply, you will link chapter number 4, exemptions, IGST entry, that if the import of service by individual or government, it is for any reason other than business, trade, commerce, it is exempt, but except OIDAR. So guys, please don't make a confusion. You have to have a structured thinking. Step number 1, we need to see whether it is a supply or not. And in step number 2, we will see whether there is an exemption or not. So firstly, make it a supply, whether it is a business or not. 7.1b, you make it a supply. If it is for other than business, except OIDAR service, it will be exempt. If it is OIDAR, it will be taxable. Who will pay tax? We will see in chapter number 3, section 14 analysis we will do. Okay, is it clear? And if there is no consideration, you apply schedule number 1, paragraph number 4, where two things you need to check. Two conditions. First, from whom you are importing. It should be your own establishment or it should be your related person. Second condition, it should be in the course or furtherance of business. And obviously consideration is not there. If both of these conditions are satisfied, yes, it is an import of service. If not, it is not a supply. Okay. If yes, it is an import of service and it is a supply. Now, liquidated damages, check, fine, dishonor. There is a certain list of items that we learn. In what context? We understand these entries in the context of paragraph number 5e, schedule number 2, that is agreeing to the obligation of doing something, tolerating something, and those things we analyze and study, right? Now there is a certain analysis part where there are 5-6 items which are analyzed, that whether it is a consideration or not, as to whether there will be a GST involvement or not. Now at the end of the day, chances are that ICI will test only those items which are given in the material, right? So those you need to learn. At the end you need to learn, because our entry and our adjustment needs to be correct. So for example, the liquidated damages, we know that it doesn't become a consideration, it doesn't become a supply. But what is the reasoning that you need to use? The reasoning and the golden line I want in your notes is that it is not for tolerating, but it is for not tolerating. Now there is a subtle English involved here. It is not for tolerating, but it is for not tolerating. So when the parties enter into a contract, they do not enter into the contract to earn the liquidated damages amount. It is just to discourage the breach of the contract. right? It is just to discourage the breach of the contract. It is a mere flow of money from one party to another. It is not a consideration. It was not the objective to earn that money. So this is the line you need to quote, that it is not for tolerating, but rather it is for not tolerating the breach. It is a mere money flow, not a consideration. So wherever GST is applicable, please make a note of it. Late fees, forfeiture in case of travel and tour industry, lease termination, prepayment of your loan, and if there is any penalty charge, here it is toleration. Here the GST is applied. At the end of the day, these topics are a little subjective. Hence, you need to make a note of it because these are the ones which are mentioned in your material. No GST, where the GST will not be applicable: liquidated damages, check dishonor fine, law violation fine, salary bond, power fixed charge. Here there is not for tolerating, but it is for not tolerating, and here there is no consideration involved, right? Now, there was a recent clarification with respect to the penal charges which are charged by the banks and NBFCs. Penal charges are again to discourage the non-compliance of the terms of the loan contract. Hence, they are treated just like liquidated damages. What is the meaning of it? That means there will be no GST involvement here as well. Yes. Next, a small entry which was asked in your MCQs, right? It was asked in your MCQs, case study MCQ, that if there is a hotel, right? The hotel was there in the question. It was providing a stay to the employee, say worth rupees 25 lakh, out of which 5 lakh rupees was used by the employee as a voucher, which was given by the company only. Right? It was given by the company only to the employee. It was a part of the employment agreement. They had asked that what is the valuation of supply by the hotel to the employee. The answer is 25 lakh. Now here you might be thinking that, sir, here why didn't we apply the concept of employee to employer in the course of employment? See, here it's a little opinionated, means alternate point of views are possible, but a reasonable point of view that ICI has taken, that this is a supply by employer to employee, not by employee to employer. Okay, some part of I would say a contradiction where I would also support that okay, an alternate point of view is possible, is with respect to the use of the 5 lakh voucher, because it is a part of employment agreement. But we have to stick to the ICS point of view that this is the supply of service by employer to employee. This is not by employee to employer. So we are not applying schedule number 3. It is a supply by employer. It is worth rupees 25 lakh. Hence the valuation of supply you have to take as 25 lakhs. Yes. Next, amount paid to the new joinee to not to join the rival firm. This will be, is it in the course of employment? Answer is no. This is not in the course of employment. This is an agreeing to obligation of doing something. This is an obligation to not to do something, not to join a rival firm. So the employee is giving the supply of services and it will be taxable. The GST will be applicable. See, perquisites and gifts, there is a simple difference. Perquisites are a part of employment contract. Hence, they are covered in schedule number 3, paragraph number 1. That is the employee services to employer, and correspondingly they get the salary and the perquisites. Hence, no GST. But the gifts are not a part of employment contract. Hence, you will apply the proviso in paragraph number 2, schedule number 1, which states the limit of 50,000. If the amount is exceeding 50,000, if the gifts are exceeding 50,000, the complete amount will get taxed. Otherwise, there will be no taxation. Okay, otherwise there will be no taxation. Sir, why did we analyze paragraph number 2, schedule number 1? Because guys, employer and employee are in a related person relationship. Yes, explanation to section number 15. So here you have to see the 50,000 limit per employee per financial year. Per employee per financial year. Next, independent director remuneration will always be under GST. It can never be under salary, because independent director can never be an employee. Okay, this is said by section 149 subsection 6 Companies Act 2013. And RCM will apply for any director remuneration only when it is under official capacity. If the director is giving some personal capacity services, not in respect to his post of director, that will be going under the forward charge mechanism. Okay, next, just a point to be noted from the definitions. Agriculturist, only an individual and HUF can be agriculturist, provided they are doing the cultivation of land, or families involved in the cultivation of land, or your hired labor is there, but again personal supervision is involved. So only individual or HUF, not a company, not a partnership firm, not a body corporate, nothing else. Father-in-law, this was tested in your September 25 exam. That is father-in-law a part of family? Answer is no. Father-in-law in Indian families, you call them father only, but still it is father-in-law. It is a spouse father. So in the family, who all are included? If you remember our revision, Parents, see, spouse and children are always a part of family regardless of how much they earn, whether they are independent or not. So my wife and my children, I'm not married, but my wife and my children will always be a part of my family. Beyond that, parents, grandparents, brother, sister, do it like this. Parents, grandparents and brother, sister, they will be a part of your family only and only if they are wholly or mainly dependent. If not, so question will be very indirect here. That question will say you that your brother is a well settled employee, or he's a well settled consultant, he's having his own factory. That simply means, it simply indicates that they are not wholly or mainly dependent on you, right? So in this case, what will be the implication for our GST? They will not be a part of family. If they're not a part of family, they will not be a related person. If not a related person, the transaction value can be accepted as the valuation of supply, section number 15. Because one of the conditions in section number 15 is that the person should not be related to each other. Is it clear? Next, just a point to be noted, exempt supply needs to be a supplier first. Sometimes they test this, that if any transaction is falling under schedule number 3, it is not a supply. If it is not a supply, it cannot be an exempt supply. Similarly, it goes for zero rated supply. Okay, so if something is a supply, then it can be a zero rated. And just a point to be noted, zero rated supply is not an exempt supply. Exempt supply, we know section 2 clause 47, nil rated, or it is exempt under the notification, or it is a non-taxable supply. Clear? Yes. Okay. So now we will move on to chapter number 2, that is the chapter of charge. Solving approach I want you to have for services. First analyze exemption, and then you analyze the RCM FCM aspect. Sir, why? Because see, first we will see whether something is taxable or not. If it is taxable, then the question comes as to who is going to pay the tax, whether the supplier will pay or the recipient will pay. Sir, why didn't you tell this for goods? Because in case of goods, the exemption is not a part of our course. Next, let's start. Recovery agent services to, for example, a trader of goods. This is not going to be under RCM. So in the paper, we are into the habit, recovery agent, put it under RCM. No. It will be under RCM when the recipient is a bank or a NBFC or a financial institution. But here it is a trader of the goods. So this will be under forward charge mechanism. Silk yarn manufacturer may be registered or maybe even a company, does not matter. See, if you remember the goods RCM table, what is the RCM entry says that if the supplier is a silk yarn manufacturer and the recipient is a registered person, it will be under reverse charge mechanism. Now the supplier only they have stated silk yarn manufacturer. They have not stated registered, unregistered, company, not a company. They will try to confuse you. You have to be very selective as to what we need to focus upon and what we need to discard and what my GST treatment has to be. See, tax laws are very specific, right? So you have to ignore the information which is irrelevant. Here they have mentioned silk yarn manufacturer, registered, unregistered, company, LLP, private limited, public limited, I don't care. Recipient is registered. This will go under the reverse charge mechanism. Yes. Priority sector lender certificate, remember it is always a nature of goods. Always it is considered as inter-nature transaction and always reverse charge mechanism applies. Next. Security services under RCM. What is the supplier recipient condition for security services under RCM? Supplier is other than body corporate and recipient is the registered person. Except two cases, recipient is the person who is registered under GST solely for TDS compliance, government agencies, and second, it is a composition supplier. Okay, so pay attention. Now, if they have given an entry, this is for your question number 114 marker, that if supplier is a body corporate and mention that he is unregistered, will there be any ITC involvement? Answer is no. Understand, structured thinking. First, see, supplier is a body corporate, so no question of RCM. It is going to be under FCM. Now, first we see that, okay, this is going to be under FCM. Next question, will actually the GST be charged in the invoice? No, because the supplier is unregistered. There would be no GST involved in the transaction and hence no question of ITC for the recipient. But sir, you don't say this when we talk about RCM. Guys, in RCM section 24 applies, mandatory registration, GST 100% is going to be there. But in FCM, you have to see whether the supplier is registered or not because the registration threshold applies. Is it clear? Next. With respect to the GT analysis, before analyzing the RCM aspects, check whether the supplier is a GT or not. GT is a very specific definition, two conditions. First condition is they are supplying services with respect to transportation of goods by road. with respect to transportation of goods by road. With respect to means it is transportation service plus ancillary services. And second, they should be issuing a consignment note. If one of these conditions is not complied, it is not a GTA. If it is not a GTA, the service will be exempt, because service of transportation of goods by road except GT and courier is exempt. Yes, just a point to be noted. Goods transport operator is not a GTA. Regardless of what rate of GST is applicable on the GTA service, RCM 5%, FCM 5% or 12%, recipient is always going to get the ITC. See guys, understand, whenever there is an inward supply, there are two aspects of analysis. First aspect of analysis is who is going to pay the tax. And second aspect of analysis is with respect to the ITC. So regardless of who is paying, for recipient you will always check whether ITC is available or not, subject to the compliance of chapter 7. Yes, that is the ITC chapter. Pay attention on who is paying the GTF rate. That person is recipient. I cannot stress upon this enough. A lot of mistakes happen here. Whenever you are analyzing RCM, whenever you are analyzing place of supply, guys, the first fundamental understanding you need to have is who is the recipient. If, for example, I am selling goods to Mr. Ram and I am paying the freight of GTA. So for the GTA service analysis, where you see whether it is an exempt or not, my recipient status needs to be taken care of, because recipient is the person liable to pay the consideration. If I'm paying the freight, I'm the recipient of the GTA service. The GTA is giving services to me, and whatever goods I'm selling to Mr. Ram, that is a separate transaction. Okay, pay attention. Just now, as I stated in this particular point, if freight is paid for inward transport of exempt goods, RCM I need to comply, but I will not be getting ITC because it is an exempt goods. So two different analysis, two different understanding. Yes, metal scrap short summary I am creating here. Pay attention. Unregistered supplier selling to registered recipient, it will be under reverse charge mechanism and obviously no TDS. Unregistered to unregistered, both are small people, no tax, no TDS. Registered to registered, normal FCM, TDS. TDS is applicable only in this case. Registered selling to unregistered, FCM, no TDS. Okay, this is a short summary where I am linking RCM with section number 51. Property on rent, just a point to be noted, for commercial property there is no exemption. Only the exemption exists entry number 12 and 12A for a residential dwelling. Commercial property on rent by unregistered supplier giving to a registered recipient. Yes, and this is a commercial dwelling. This is a commercial dwelling. This will be under reverse charge mechanism, except in one case where this person is a composition supplier. In that case, no tax, no GST. Okay. Renting of immobile property by government, RCM will apply only when the recipient is a registered person. This is a part of analysis of your services by government, right? So pay attention. I am not using the word the person whose last year turnover exceeds the threshold. No, these both are different things. Guys, just a point to be noted. Last year turnover more than or less than threshold. This is a separate concept. Actual registration is a separate concept. I will explain you. It is possible that my last year turnover was exceeding the threshold, but I am not registered because maybe it was an exempt supply. Vice versa, let's say my last year turnover was not exceeding the not exceeding the threshold, but I have taken registration, maybe due to section 24 mandatory registration, maybe due to voluntary registration. Yes, okay. Now there is one entry with respect to the RCM for motor vehicle on hire. 2 points to be noted. One, the question will state you the condition that consideration should be including the cost of the fuel. Okay. And second, this motor vehicle that I'm talking about, it is the one which is designed to carry passengers, not goods. Right? Sponsorship. Sometimes, as you know, the RCM entry, supplier, any person other than body corporate, and the recipient is a body corporate or a partnership firm. Now in the sponsorship, sometimes it creates a problem to identify who is the supplier and who is the recipient. Simple. Supplier is the person who is receiving the money, providing the service. What is the service in sponsorship? Promotion, advertising in events, and recipient is the person who is paying it. So I am, let's say, organizing a cricket tournament in the name of, let's say, PC Jewelers. So PC Jewelers is paying me. I am receiving the money. I am the supplier and it is the recipient. Yes. Next, in the composition scheme 10.2a, that is the services composition scheme, the person will be eligible under 10.2a if the person is not eligible under 10.1. Actual registration or not registration under 10.1 is not relevant. You should not be eligible under 10.1. If I am eligible under 10.1, I have not taken registration under 10.1, I will not be eligible under 10.2a. Another point to be noted, this was asked in one of the questions, that if a person is already registered under 10.2a, so while registering, I was not doing goods supply, I was not eligible under 10.1, and later on I want to start the supply of goods. So this is not specifically restricted, hence allowed. Hence this is allowed. This is very, very important. Very important. This was asked in one of the questions. From the rates, just a point to be noted, composition levy for traders, it is not 1% of the turnover in the state, it is 1% of the taxable supplies in that state. Okay, manufacturer has to pay 1% on the turnover in the state, restaurant has to pay 5%, that is 2.5 plus 2.5, and always write 2.5 plus 2.5, 0.5 plus 0.5, because composition suppliers only make intrastate supplies. Next, marginal services that we allow in the second proviso to 10.1. First, you need to check the limit whether the services are in the marginal limit or not. If the answer is yes, the person can continue under 10.1. But guys, here there is a mistake, chance of a mistake. Please don't forget to put composition levy on that marginal services limit. So let's say I'm a trader, I'm also giving services. First, you check whether the services are within the limit, that is last year's turnover in a state into 10% or 5 lakh, whichever is higher. And second, if it is within the limit, you apply the 1%, that is 0.5 plus 0.5, 1% on that marginal services also. Sometimes here a mistake happens that you check whether it is within the limit or not, but you forget to charge the composition levy. Don't do that. Then we have a certain list of notified goods like the ice cream, the brakes and all that, refactory, all those goods. Composition levy is not allowed for the manufacturers of those particular notified goods. Trader, it is allowed. Trading, it is allowed. Only manufacturing is not allowed. So make a note of it. Is it clear? Okay, next chapter, chapter number 3, place of supply. Let's start. First point to be noted, please practice the structured thinking approach whenever you are talking about place of supply and whenever you are applying the section. First, think whether it is a case of goods or is it a case of services. Then in goods, apply section number 10 or 11 carefully. 11 is import export. Especially in services, see if the location of both supplier and recipient is in India. If yes, then apply section number 12. If one of them location is outside India, then you apply section number 13, right? And the sections that you are going to quote for this chapter are of IGST, not of CGST. So whenever you are quoting any section, ensure that you are writing that correctly. Next, 10.1b, there is a typical treatment involved. Although, as you know, in section number 10.1b that deals with the place bill to ship to model, there are typically two supplies which take place. But in some questions, in one of the MCQs as well, what they are doing is, whenever these words instruction or delivered on the instructions, whenever this word is written, then regardless of the fact that there are not two supplies, the ICA is applying 10.1b. I will give you a very simple example. Let's say supplier is in Gujarat, I am in Maharashtra, and I am buying the goods, and on my instructions the goods are being sent to Rajasthan. Very simple example. There is only one supplier, not two supplies. But because the word on the instructions, and because I said the goods are being delivered to a particular venue, they have applied 10.1b. And the place of supply, they will make it as per the 10.1b and fix it as my principal place of business, that is in Maharashtra. You apply 10.1b there. Okay. Next. There was a circular clarification with respect to e-commerce, where typically you buy goods online, you are an unregistered person, and you give a shipping address, that is the delivery address, which is different from the billing address. So billing address is, let's say, Pune, Maharashtra, but the delivery address I'm making, let's say, Delhi. So here you are going to apply 10.1 CA, that is unregistered person buying the goods. Answer of the place of supply will be where the delivery is made. So you are going to apply 10.1 CA here. Just ensure the person is unregistered person, and this is on the basis of a circular clarification. Apart from that, just a point to be noted, 10.1 CA overrides 10.1 A and 10.1 C, and in 10.1 CA, where you typically apply the physical purchase of OTC sale by an unregistered person, you do not require the exact address, only the state name is sufficient, because sometimes the question will state that exact address is not there. It's fine, we don't need that. In section number 12 subsection 3, that deals with basically the immovable property. If that particular location is happening in more than one state, Point number one, firstly, you need to quote about the bifurcation as per every state involved will happen as per the contract agreement. Don't directly go and jump to the rules. You don't have to quote it directly. First mention about the point that it will happen as per the contract agreement. And if it is silent, then we will apply the rules, which is the rule applicable here, rule number 4. In rule number 4, one of the tables, in the table we see the first point, the bifurcation happens as per the number of nights stay. That is applicable only and only when it is a case of lodging and it is a case of separate property. That is two different physical properties. Often I have seen that students learn only the lodging part. No, lodging is there, but that is in a separate, those are separate properties, separate units of the hotel, and then there the lodging service is given. So any one of these conditions is not met, the bifurcation will happen as per the serial number 2 in that table, that is the area lying in each state. So for example, it's a separate property, but the service is with respect to, let's say, architect. So you will bifurcate as per the area lying in each state of that property. Okay, next. General, certain points to be noted. General advertisement service, you are going to apply 12.2, not 12.14. 12.14 applies only when advertisement is given to the government, that is CG, SG, state body or any local authority. Advertisement by way of promotion on boards or merchandise in event, that becomes a form of sponsorship, and sponsorship is covered under 12.2, that is general advertisement. Okay, next. Section number 13, that is when location of the supplier or recipient is outside India. In subsection 3, that deals with the performance based services. In clause number A, that we deal with respect to the goods, and there is an exception number 2. This is the temporary import into India for the purpose of RTP, repair treatment process, and the goods are then exported back. Now here there is one very essential condition. See, the exception is that here the answer of the place of supply is not where the services are performed, but rather the location of the recipient. But the condition is that the goods should not be used in India. If nothing is given with respect to the use, then you have to put a clear assumption and take both the answers, or maybe you take an assumption and then you quote one answer that, okay, I am taking the assumption that the goods are not used in India, and hence the answer is location of recipient. Contrary, if you say that we are assuming the goods are used in India, then the answer of place of supply will be India where the services are performed. Is it clear? Okay. Hiring of aircraft, hiring of vessel. Now I am talking about section number 13, subsection 8 here, that deals with the intermediary services, services by bank to its account holders, and we also talk about the hiring of motor vehicle. Now here where I say basically hiring of the vehicles and everything, it includes a yacht, but it does not include aircraft and vessel. And whatever hiring is covered here, that too is also up to the period of 1 month. So if let's say aircraft vessel hiring for any period, even if for 1 day, and others if it is more than 1 month, then 13.8 is not going to apply. You are going to apply the default provision 13.2. Next, we are creating a small quick summary with respect to the section number 14 and section number 14A of IGST linked with section number 24 mandatory registration. What is section 14 and 14A? We are going to talk about the OIDAR services and online money gaming when the supplier is outside India. If supplier is in India, normal taxation applies, normal GST applies, nothing different. But if the supplier is outside India, we are going to apply section number 14 and 14A. Now pay attention. Now first I will talk about section number 14. Now in section number 14, if the supplier is outside India and the recipient is in India, and if the recipient is a registered person, RCM will apply import of service. Supplier doesn't have to take any registration in India. Okay, RCM will apply. But if the recipient in India is unregistered, that is, he will be called NTOR, non-taxable online recipient. He is taking OIDAR services and the recipient is unregistered. Here section number 14 will apply. Supplier will have to take registration in India, mandatory registration, and he will have to pay tax under the forward charge mechanism. But when we cover this from online money gaming point of view, section number 14A applies. Supplier is outside India. Here recipient may be registered, recipient may be unregistered. I don't care. Section 14A will apply. FCM will apply. IGST has to be paid under forward charge mechanism. Now in both the cases, simplified registration scheme is applicable. That is, they don't have to take state-wise registration. They have to take simplified registration, single registration for the entire country. Correct? And if they are not in India, but they have a representative in India for any purpose, they can pay the tax. If they are not there in India, if there is no representative in India for any purpose, then they have to ensure that they appoint someone to pay the tax on their behalf. They have to pay. It cannot be an excuse that there is no one representing that person in India. So this is section 14, 14A linked with the section number 24, 24 of CGST, 14, 14A of IGST. Is it clear? Okay. Now next, in the exemptions chapter, The first entry that we talk about is the charitable activities, in which there is one particular, basically the charitable activities are defined. One of the entries and clauses is the educational programs and skill development. Now, when you are giving this to the persons in rural area, they should be more than 65 years of age. So this is one limit, and they should be in rural area. What do you mean by rural area? It is defined as per the village records. Now, another age limit comes when we talk about the old age home run by government or registered charitable entities, that is 12 AA of the Income Tax Act. Here, the resident age should be minimum 60 years. Minimum 60. So minimum more than, sometimes ICI plays on these particular limits as well, right? And here the consideration should not cross 25,000 per person, that is per member per month. Up to 25,000 is allowed. If it is 25,000 rupee, entire will be taxed. It will not be covered under exemption. Now, similarly, the entry related issue comes here, that one of the charitable entries we cover is when the charitable activities, when the charitable entities, they rent out the precincts of the religious place which are meant for general public. Then in that case, exemption is applicable for the shop, Kalyana Mandapam, that is the community hall, and the room rent. So that exemptions are applicable only up to a certain limit, that is 999. This is room rent per day, 9,999. If it is a Kalyana Mandapam, it is for the entire day. If it is a case of shop, then it is for entire month. So the point to stress upon here is that up to these limits, the exemption is applicable, because if you see these limits right now, if you see this video, and you might be able to remember this particular limit. Contrary, if the question directly asks 10,000 or 1,000, then it creates some form of a confusion. So I hope you are able to remember this, that sir told that up to 999 or 9,999, we will get the exemption. If it touches 1,000, if it touches 10,000, the exemption is gone. No exemption tax will apply. Next. Training, coaching in recreational activities with respect to arts and culture is exempt when it is given by individual, but not sports. Sports training is exempt only and only when it is given by a charitable entity. These kind of things can be played upon in the MCQ. If paper is supplied to an educational institution, it is taxable. It is not a service. Paper buying is a goods. You have to tax it. Security, cleaning, housekeeping is exempt only and only when it is provided to school and in school. To school and in school. Catering and other things, they may be in school, outside school, we don't care. Okay, so there are three things which are exempt only when provided to schools: catering, security, cleaning, housekeeping, and the transportation of SFS. Now here also there is a structured thinking involved when we talk about the educational institutions. Right? How come the structured thinking is involved? Services to and services by. So if the services are by educational institution, that is the outward supply. And if it is to, means someone is providing to an educational institution. Here 5 cases are covered, out of which the 3 we discussed, it is only and only exempt when provided to a school. With respect to the conduct of examination, entrance exam and everything, that is when it is provided to all 3. Right? And online journals exempt only when provided to a college, that is the ones who give the curriculum recognized by Indian law. So you need to have a structured mind ready. Yes, certain other points to be noted. Healthcare exemption. Healthcare can be at home as well, not necessarily at a clinical establishment. Air ambulance is exempt. Reiki is not a recognized system of medical care, so taxability will be there. With respect to ERCC, now if you are not gone into the details of how the ERCC entire concept works, what is the transaction, at least learn this for your exam. ERCC GST exemption will be up to the amount of GST paid by the mining lease holder. Okay, if let's say the mining lease holder GST is 10, ERCC is 12, then 2 rupees has to be paid by the ERCC. If it is till 10, exemption, right? Okay, and if that in my example of 12, the 2 rupees that has to be paid by the ERCC, that will happen under the reverse charge mechanism. Now next. Construction services, there are certain points to be noted. The exemption is only for the pure labor contracts, not your goods contract, only pure labor contract. Second, the exemption is only for the residential individual houses, no societies, no complexes. So whenever you see the commercial word, you have to shoot at sight, means it is going to go under the GST. Next particular point you need to pay attention to, that when the scheme is under Pradhan Mantri Awas Yojana or Housing for All mission, that it includes repair, maintenance, renovation along with the original work. But if it is not under government scheme, if it is happening on a private level, then only and only original work will be concluded. Only and only original work will be included for the purpose of your exemption. And if it is given renovation, repair, maintenance, then in that case you will not get any exemption unless it is under Pradhan Mantri Awas Yojana or Housing for All mission. So these terms you have to pay attention to in the transaction. Wherever you see some term which is not eligible for exemption, you put it under GST. Yes, okay. Non-AC contract carriage and non-AC stage carriage, if they are provided through a ECO which is liable to collect tax under 9(5), basically the deeming provision applies. There the taxability will happen. There will be no exemption. Now, the goods specific exemption, entry number 20 and 21, in which we cover the organic manure, registered newspaper, calamity related defense equipment, calamity related relief material, those exemption we cover, right? The goods specific exemption, that is exempt only and only when it is provided by the way of GTA, rail or vessel. Air is not covered. So if it is through air, the GST will apply on that particular freight amount, right? Next. Entry number 34, that is the service by acquiring bank up to settlement of rupees 2000 rupees, that is applicable to a payment aggregator as well, not to a payment gateway. There is a difference in payment aggregator and payment gateway. I will try to tell you in 15 seconds. Basically, the payment aggregator have the control over funds as well. So essentially, they do perform the settlement function, but payment gateway is not having any control. It just provides the infrastructure for routing the payment directly to the vendor's account. Next, micro life insurance product, one of the exemption category. So what do you mean by micro life insurance product? It means the cover is up to rupees 2 lakh. Okay. Next, with respect to this BCBF, the entire spectrum, I will just give you a brief revision of the exemption entry as well for BCBF, and then we will see the RCM FCM part. Okay, pay attention. With respect to rural area, banking industry, everything is exempt. So BCBF providing to a bank or an agent providing to the BCBF. BC means the business correspondent, BF means the business facilitator. Now, when we talk about the insurance industry, the BCBF providing services to a bank to an insurance company is exempt in rural area. But if any agent is providing services to BCBF, it is taxable. This was just a part of exemption analysis. Is it clear? Now, let's talk about the RCM FCM part. So the field factor you need to make a note of is business correspondent is doing proper business. He's involved in the business, more responsibilities he takes. So BC is going to pay the tax on his own. We don't need to give any benefit of RCM to a BC, that is the business correspondent. So from that point of view, pay attention. If BC is providing services to a bank, no need of RCM benefit, FCM. BF is a small guy comparatively, so we will give him the benefit of RCM, but this is only when it is a bank, not when insurance is covered. So BF to insurance, it will go under forward charge mechanism. Yes, agent of BC to BC, BC is liable to pay, BC can pay, why to trouble the agent? So let's put it under RCM. And agent of BF to BF, both are small people, so normal taxation and normal FCM will apply. Beyond this, I don't think ICI will ask. Next, entry number 3 and entry number 3A, that we talk about the services to the government, pure supply, and 3 is a composite supply involving goods. Now we know the exemption exists. Here there is an exemption condition of 25% goods. Yes, for the goods, the condition is it should be 25% of the total value Pay attention. This is when it is provided to CG, SG, UTLA, not a governmental authority or governmental entity. If recipient is given as a governmental entity, it was asked in one of the exams, one of the attempts basically, and there you are not going to give the taxation benefit. No exemption benefit will apply. The GST will be applicable. Another point to be noted, when these services are given, they have to be with respect to some activity entrusted to a panchayat municipality under article number 243G or 243W of the Constitution of India. Yes, horticulture and horticulture works to the Central Public Works Department apply entry number 3 and 3A. Entry number 3B, that is the slum development, water supply, that is exempt only when given to a governmental authority, not governmental entity, not central government, not state government, nothing, only to a governmental authority. Yes, and as you remember, RERA is now considered as a governmental authority, so the links can be created when they ask the questions. DMFTs, that is the District Mineral Foundation Trust, they are also governmental authority, maybe they link some kind of an exemption here. Next, if a means of transportation of passenger is given on hire to a GTA, it will be taxable. Exemption will be only when it is a means of transportation of goods. Point to be noted, services by foreign diplomatic mission is exempt. Okay, so services to foreign diplomatic mission are taxable. Service by way of storage, warehousing of raw material, raw vegetable, fiber such as cotton flax, these are not technically agriculture produce, so you have to tax it. It was asked in one of the attempts. Time of supply, I just want you to revise 13.3 carefully. 13.3 is the recent amendment where self-invoicing concept was kicked in. So basically, if the recipient is liable to issue the invoice, that is 31.3F. When does 31.3F apply? When it is a case of RCM supply and the supplier is unregistered. So here 13.3, you have to compare two dates, payment date, that is by the recipient, versus self-invoice date, right? If the self-invoice is not issued within 30 days, ICI has taken an alternate point of view where it has taken the 30th day as the comparison date. So I want you to revise 13.3 properly and do the question of September 25. September 25, they had asked it. I don't think they will repeat that immediately in your Jan attempt, but the concept should be clear. Maybe some other form of testing is included. Next, valuation. See, if there is any need to go to the valuation rules, don't get carried away by the information. A lot of times they give a transaction which is maybe not a supply, or maybe which is complying all the conditions of section number 15 subsection 1. That is, supplier recipient should not be related to each other and price is the sole consideration. But they put in the information of the valuation rules, and maybe in the haste of doing things, we quickly jump to the valuation rule. I will give you an example. Free of cost training given to agents who are not sole agents, normal agents, and it is a free of cost training service. So will paragraph number 3 schedule number 1 apply? Answer is no, because that applies only for goods. So here it is not a supply, but they will give you the information of valuation rules. Guys, there is no need to apply rule 29 or any other rule for that matter, because it is a clear case that it is not a supply itself. So ensure it is a supply first. Then you see whether it is a notified service for which we need to apply rules, like for example online gaming money or any other thing, right? And secondly, online money gaming is a case of goods, or 31A, 31B casino, betting, gambling. Or see if the 15-1 conditions are complied or not. If 15-1 conditions are complied, your transaction value will be accepted as your valuation. So don't jump to the conclusions, right? Mandi tax, municipal levy, these are the examples of 15.2A. These are the other taxes which are not subsumed under GST. They become a part of your valuation of supply and on which the GST is applicable, but they will be excluded from the turnover everywhere else. For example, rule number 42, where you calculate the apportionment of ITC, ISD turnover, everywhere all other taxes like excise duty are excluded. Only they included under section number 15 so that the GST is collected on that amount. Rule number 28, distinct person or related person, please pay attention. Invoice value shall be accepted as deemed open market value when only and only when the recipient can take full ITC. And this is applicable for both goods and services, right? But you know, there is a first proviso which gives you the option of taking 90% of the price of like kind and quality when the goods are sold as such to a further unrelated customer by our recipient. So basically what is happening here, let's say A and B are distinct person and B is further transferring to C who is unrelated. So like kind and quality is sold for, let's say, rupees 100. This supply will be at rupees 90. This is an option given. Now this option, please pay attention. Two conditions you need to apply and check in the paper that this particular option will be only in two cases. Condition number 1, rather I should say condition number 1, it is only applicable for goods and only when the goods are sold as such. If there is any processing or any conversion which is happening, then in that case we are not going to be applying any form of rule number 28. I hope this is clear. Yes. Okay. Next. This is done. Just a point to be noted. When you are transferring to a recipient and the transfer, that is, this is the distinct person or let's say related person. And if this transfer is happening for the purpose of distribution as free sample further, then in that case, you cannot apply this concept of invoice value as deemed open market value. Why? Because the credit is blocked in this case. In this case, the credit is blocked. And if it is blocked, the recipient cannot take ITC. If the recipient cannot take ITC, the invoice value cannot be accepted as deemed open market value. I hope this is clear. Corporate guarantee 28.2. Basically, you apply the 1% of the guarantee amount, you compare it with any actual consideration which is charged. Okay, that is applicable only when the recipient is in India. That is the person on whose behalf, the guarantee is being given. Okay, next. If the recipient is eligible for full ITC, here also invoice value will be accepted as the deemed open market value. Now certain points to be noted. There is a concept known as pre-supply discount and post-supply discount, which is applicable in section number 15 subsection 3. Now please don't learn that this discount is pre-supply, that discount is post-supply. No, it doesn't happen that way. Pre-supply, the condition is that the discount is recorded in the invoice value. This is the only condition. Don't categorize by the names, only see whether something is recorded in the invoice or not. I will give you one classic example. In ICI case, they had mentioned that let's say I have issued the invoice and I went to deliver the goods to a recipient, and when he paid the entire amount at one go, I instantly gave him a 2000 rupees discount. Is this a pre-supply discount? Answer is no, because it is not recorded in the invoice. Is it a post-supply discount? Yes, but will the valuation be adjusted for the post-supply discount? No, because the conditions will not be complied. There is no agreement of this particular post-supply discount. Clear? Okay. Subsidy is a mini summary. If there is any subsidy given by central government or state government, don't even see what kind of a subsidy it is. It will never be a part of your valuation. If the subsidy is given by non-government, it will be a part of the valuation. Section 15(2)(e) only and only when it is price linked. Price link means, let's say I am selling goods. So per good, per item, I am getting a subsidy. If it is a blanket subsidy or a general subsidy, means for the entire year I get 10 lakh rupees regardless of how much I am selling. That is a blanket subsidy. Now it may be given by non-government, still it will not be a part of my valuation. Is it clear? Next, with respect to agents, don't forget to apply the invoice test first if there is no consideration involved. And if the supply is happening, it is a supply as per chapter number 1, then you apply the valuation rules. You apply rule number 28 for sole selling agent, sole agent, and if it is a normal agent, you apply rule number 29. So point to be noted, if it is a sole agent, you apply rule number 28. If it's a normal agent, you apply rule number 29. Don't commit a mistake here. This is important to note. Sole selling agent is a related person, hence we apply rule number 28. Okay, next chapter, chapter number 7, ITC. Let's start. E-invoice without the invoice reference number is not a valid document. So for the recipient, there will be no ITC. This can be asked in one of the adjustments. One of the rules that says that the supplier invoice needs to be paid within 180 days, and if it is not paid, then when this 180 days expires, then ITC reversal has to take place. Now this is not applicable in 3 cases, right? One is RCM supplies, second is deemed supply schedule number 1, that because there is no consideration, and second with respect to the valuation of the valuation part, which is with respect to 15(2)(b), that is supplier's obligation paid by the recipient. So he has already paid, so he's not going to pay it again to the supplier. So in these 3 cases, you are not going to apply this condition. It will be stated in the question. So please be attentive that will be no reversal for this amount. Now 16(4), there is a time limit to avail the ITC. The time limit to avail the ITC with respect to the debit note, the 30th November from the 30th November of the succeeding financial year. So succeeding to what? What is the base financial year? For that, we have to see the date of the debit note, not the date of the invoice. So possibly the invoice can be, let's say, 28 March 2025, and the debit note, let's say date is 3rd April 2025. So in that case, the 25-26 will be the relevant financial year for the debit note related ITC. Right. Next point to be noted is this is not applicable on the reavailment of credit. So if you reverse the credit and then you reavail it, for example, that 180 days thing that we covered, and if later on I as a recipient pay that amount, then in that case, obviously I will be able to get the ITC again. So there 16(4) does not apply. It applies on the original availment of the credit. Next, now there is a concept that for rule number 42, you calculate special exempt supply. So there is basically exempt supply as per the GST law, and there is one calculation of exempt supply for the purpose of reversal and apportionment under rule number 42. In that, specially you have to include certain things which are actually not exempt supply, but for the purpose of rule 42, they will be included in the numerator as well as the denominator, right? So they will be included in the numerator as well as the denominator. So let's see. Outward RCM supplies, securities transaction, you have to take 1% of the sale value. Land and building, you have to pick the circle rate, that is on which the stamp duty is paid. Sale of warehouse goods before clearance for home consumption, that also you have to include. Actually, some of these are not even supplies, right? But still you have to take it in the exempt supply for the purpose of rule 42. So here the sale of warehouse goods, what valuation you will pick? The value of the sale in the duty-free shops. This will be given in the question. And secondly, for other than banks, you have to exclude the interest income. So interest income is actually exempt, but for the purpose of rule 42, you will not be including it in the numerator. I'm just reiterating one small point. These inclusions you have to add in the numerator as well and in the denominator as well. This exclusion you have to exclude just from the numerator, but it will be a supply. It will just not be an exempt supply. So it will be a part of the denominator, but not a part of the numerator, right? Okay. So this is done. Next, rule number 43, that is with respect to the capital goods, a special situation where you change the use of the capital goods from exclusive non-taxable, exclusive not available to available. So for example, I bought a machine, capital good, that was exclusively for the use of, let's say, exempt supply. But now it is coming into common credit use. So here there is a specific calculation involved that you need to pay attention to, can be asked in the MCQ as well. Firstly, what is the common credit here? Total ITC upon 60. So whatever however law deals with this situation is that it takes on the gross basis, total divided by total 60. 60 means 60 months, that is the 5 years useful life. And then whenever it is used for the common purposes, for that particular month we do into E upon F, right? So this is something you need to make a note of. And here with respect to this change, the special situation, there is a calculation involved, that is TIE, that is ineligible credit. Now what is this TIE when this special situation is covered? Let's say I bought a machine and I used it for certain period for exclusively making exempt supplies, and at this point of time we transferred the use. Let's say from this point of time it is going to be used for common credit purposes. So what about the time period? What about this time period when it has actually been used for not eligible purposes? So what happens here, how the calculation flows, that we are going to claim the 100% credit. The entire ITC I will credit in the electronic credit ledger. And with respect to this portion of time, I will calculate ITC pertaining to this period of time and I will add it into the output liability. So this is TIE, that is ITC into 5% per quarter. So I will take the total, but the ineligible part I will add to the output tax liability, and hence the netting off is done. In essence, I am taking the net ITC. Okay. Very important point to be noted. Advance with respect to the goods will be a part of the total turnover in capital F, that is the denominator we calculate in rule 42 and 43. But obviously in the time of supply we know advance of goods I am not paying the GST, but it is still a supply. Yes. For banks, FIs, financial institutions and NBFCs, there is an optional method wherein I can claim 50% credit. You know that, right? We can claim 50% credit and 50% will be reversed. But whatever is used for blocked credit, whatever is the blocked credit 17.5, and whatever is used for non-business purposes, that is 100% not allowed. So no change for those two items. Apart from that, whatever is common, exempt, taxable, you take 50%. And another point to be noted, once you take this option, for the balance financial year, part of the financial year, you cannot go out of this option. Next. When we analyze the meaning of a motor vehicle, please pay attention. Something which runs on the fixed rail, that is the railway coaches. Special purpose vehicle in factory. So this vehicle is used in the factory for the maybe the purpose of the transportation of goods or raw material. And less than 4 wheel with an engine capacity of up to 25 cc. This is not a motor vehicle itself. If it is not a motor vehicle, it is not in block credit. 17.5 is not applicable. Is this clear? Next. 17.5C and 17.5D, that is works contract and self-construction of the property. So here, basically, I have just concluded 3 cases where the ITC is allowed, means it is not blocked. So basically, there are 3 cases. I am just compiling those. First is it is a case of subcontracting. So I am not doing the construction for myself, but for my client. Second, it is going in my P&L account. So it is a P&L expense, not a capitalization. Because if it is a capitalization, then it becomes the meaning of word construction, right? So the word construction means it is going in capitalization form. And this capitalization or P&L will depend upon your AS and your generally accepted accounting principles. Third, eligible plant and machinery. So what is eligible plant and machinery? For example, the plant and machinery has been attached to the land, including the foundation and structure. So that is eligible plant and machinery basically. So for that also I get the ITC. You may face a query here that, sir, why are we talking about plant and machinery here? How come it is an immutable property? So sometimes when it is attached to the land, so it can be, categorized into the definition of the immutable property. Although immutable property, we don't have any other separate definition under GST law. We borrow it from the GCA, that is the General Clauses Act. So here, that's why when it is attached to the land, it can be a plant and it can be a immutable property, but still I will get the ITC. And obviously from the plant and machinery, you exclude certain things: land, buildings, civil structures, telecom towers, and pipeline outside the factory. Inside the factory pipeline, ITC is allowed. It is a part of plant and machinery. Now, section number 18, very important, special credit circumstances, 18.1a, 18.1b, 18.1c, 18.1d. Quickly, 18.1a and 18.1b, what is it? 18.1a and 18.1b is when you are applying for the GST within 30 days or you are voluntarily registering under GST. So 18.1a and 18.1b, you get the ITC of existing inputs whether in the raw material form, semi-finished goods, finished goods, whatever it may be, capital goods, you do not get the ITC. 18(1)(c) and 18(1)(d), technically you are a registered person already, but what is happening in C and D is your composition to regular, you are going, so from composition scheme to regular scheme, maybe your scheme is lapsing, and D is your supplies exempt and now it is taxable. Let's say the government has now made it a taxable supply. So that is 18(1)(c) and 18(1)(d). So the technical difference is in 18(1)(c), 18(1)(d), I'm already registered. In that case, I will get the existing ITC of inputs as well as capital goods. Now, when I use the word existing ITC, means whatever the relevant date is, one day before whatever material I have, I will get the existing ITC by filing ITC 01. This is the core difference. So there was a question asked that my entire supply is exempt, due to which I have not taken registration. Tomorrow that let's say my turnover is crossing 20, let's say 40 lakh in case of goods or 20 lakh in case of services, whatever it may be. But now if the question states that, let's say the exemption notification is withdrawn. So in this case, would 18(1)(a) apply or 18(1)(d) apply? See, 18(1)(d), I told you I should already be a registered person. So here my liability to registration will arise and I will have to take registration, apply for registration within 30 days, and 18(1)(a) will apply. So the point they tested was whether capital goods ITC you are going to get or not. No, you're not going to get. Apart from that, point to be noted, within 1 year from the invoice, I have to ensure that I'm claiming the ITC. Basically, that relevant date falls within the 1 year. And another thing, when you are getting the capital goods ITC, it will be subject to a reduction of 5% per quarter or part of the quarter. Okay, next, in 18(6), whenever you are selling the capital goods or plant and machinery, you compare two amounts, ITC with respect to the remaining useful life, that is reduction of 5% per quarter that you have used, or tax on transaction value, whichever is higher. But if you are selling it as a scrap sale of mold, dies, jigs, fixtures, here you don't have to compare the two amounts. You can pay tax on whatever the transaction value is, because scrap sale, the transaction value is very low, right? So this is a benefit. Then we talk about the change in constitution of registered person, where basically the ITC is transferred to the new entity. Certain points to be noted here. Firstly, liabilities transfer should also happen. This is one of the essential conditions, and the chartered accountant or the cost accountant has to certify this. Second, individual heads transfer, the person can decide. So basically, let's say my total ITC balance is 10 lakh and assets value, assets ratio transfer is, let's say 40%. So 4 lakh rupees can be transferred. But out of that 4 lakh, what would be the heads of distribution? Should I transfer it out of CGST, SGST or IGST? I'm at the liberty to decide that. I just need to ensure that total 4 lakh is transferred, not more than that, right? Then a query comes that which dates ratio of assets has to be taken and which dates ITC ledger I have to use it. Basically, the ratio of assets value, let's say 40%, is to be multiplied to the balance of the ITC ledger. So which dates ITC balance I have to pick? Because these things are subject to change, right, on a day-to-day basis. So here I'm putting a golden line, very important to understand. For the purpose of ITC apportionment, the ratio of value of assets we have to take on the appointed date of demerger or whatever the scheme may be under which this partial assets transfer is taking place. And you have to pick it, you have to apply that ratio, means you have to multiply that ratio to the ITC balance of the transferor as on the date you file ITC 02. Is it clear? Okay, now, when I'm telling you to calculate the assets ratio, that is 2 points you need to make a note of. Asset, it can be a current asset, it can be a fixed asset, I don't care. And second, individually on the asset, ITC may or may not be availed, I don't care. So whatever that percentage is, we have to pick it and multiply with the ITC balance as on the date of filing ITC 02. With respect to ISD, certain points to be noted. It may be mentioned that recipient is unregistered or maybe it is making an exempt supply, does not matter. ISD, whatever total ITC is, you have to distribute it. Next, same month distribution, if inadvertently skipped, it cannot be distributed later on. If you skip it, if you forget to put it in your GSTR 6, then you have lost the chance. Then now in the next month, you cannot do it, right? Next, question sometimes will state you ITC is of inputs. Will it be a part of ISD distribution? Answer is no. I'm only and only going to focus upon input services. Input services. Okay, inputs you have to ignore. And ineligible ITC, let's say there is some block credit, ineligible ITC, doesn't matter. You have to distribute. ISD, in Hindi we say Baba ki jholi khali karna, means whatever that bag of ISD, ITC is there, you have to distribute it. Your recipient is unregistered, your recipient is making exempt supply, this is ineligible credit, I don't care. That thing will be taken care of by the recipient. From your own side, ISD, you have to distribute the entire ITC. This is for chapter number 7. Okay. Next, let's start with chapter number 8, registration. Point number 1. is with respect to how your answer can start when the question is asking about the registration requirement and different supplies are given with respect to different states in question, right? So this will give a very good idea about basically to the examiner that you know the law well, and this will help us also while answering. This is a very good format, so follow this for your exam. First, you will write basically the registration threshold with respect to the goods when I'm dealing in intra manner and exclusive manner. Next, you will write about services dealing or goods plus services dealing. Obviously, why I'm isolating the goods case specially, because I have the higher limit of 40 lakhs, and services or goods plus services I will quote it separately. So when I'm talking about goods in intra-exclusive manner, there will be three limits for three types of states. First, MMNT, that is Manipur, Mizoram, Nagaland and Tripura. The limit is 10 lakh rupees, right? Beyond that, I will be needing a registration. Next is PT Musa. PT Musa is what? First of all, just understand the states Puducherry, Telangana, Meghalaya, Uttarakhand, Sikkim and Arunachal Pradesh. So here the limit is 20 lakhs. These are not in the 10 lakhs limit, but they also don't give you the benefit of 40 lakhs. Out of these, I want you to pay special attention to these two. PT, that is the Puducherry and Telangana. They are not special states in any manner. They are not special states as per the constitution. They are not special states under any other part of our GST law, but only in this particular case, they are refusing to give you the benefit of 40 lakhs aggregate the turnover threshold for registration. So here you need to pay attention when it is asked in the exam. And balance states, they will give you the 40 lakh benefit. And for other services or goods plus services, then in that case you just have two categorization, 10 lakh for MMNT, and others all the cases you will get 20 lakhs registration threshold. Point to be noted, if the supply from MMNT state is not taxable, so it is exempt or non-taxable, then in that case the limit will not drop to 10 lakhs. The registration threshold limit, see, if I'm dealing from one of the MMNT states and one of the normal states, then my registration threshold is 10 lakh. The registration threshold doesn't apply or on state by state basis. State to state basis it doesn't work. If MMNT gets involved in the picture, that is from MMNT state you are making any taxable supply, your registration threshold will drop to 10 lakh. But if that supply is exempt or it is a non-taxable supply, let's say alcoholic liquor for human consumption, then in that case the limit will not drop to the 10 lakhs. It will the 20 or 40 lakhs limit will apply depending it's a goods case or it is a service or goods plus service case. Puducherry, Telangana, I have told you this. I have told you this is just a point to be noted. Jammu and Kashmir, Assam and Himachal, they are giving 40 lakh benefits. Okay, first instance when we read these the name of these states, it somehow clicks. It somehow feels that these are not going to give you the 40 lakh benefit. These seem to be the special state, but no, they are going to give you the 40 lakh benefit. Now handmade goods. Now where do we study about this handmade goods? In section number 24, ready with 23. In handmade goods, handicraft goods, even if it is an interstate sale by a casual taxable person or a normal person, you get the benefit of the threshold. You do not apply, you do not get covered under the mandatory registration. Now when I'm using the word handmade, is it 100% handmade or some minor machinery use is allowed? Minor machinery use is allowed. Majority it needs to be handmade. But in one of the papers they had asked that it is 50-50, 50% handmade and 50% machinery. So that is not allowed, right? Some machinery use is allowed, but not 50-50. Rule 10A deals with the relaxation from the bank account details furnishing while filing for the registration, that is REG 01. Basically you get 30 days time limit, so 30 days or GSTR1 filing, whichever is earlier. So you have some relaxation, but that relaxation does not apply in three categories: TDS deductor, TCS collector and suo motu registration when the PO registers you. Okay, chapter number 9, tax invoice, debit note and credit note. Certain points to be noted. SEZ units are exempt from the invoicing concept, but not the SEZ developer. SEZ units turnover will be included in the aggregate turnover to check whether invoicing is applying or not. So for example, there are two units of a company A and B. A is in the domestic tariff, basically the DTA domestic tariff area, and B is, let's say, an SEZ unit. Suppose turnover of A is 3 CR and turnover of B is 2.5 CR. So the total is 5.5 CR. And when I say 5.5 CR, it is crossing the limit of 5 CR. Invoicing concept will apply. But after application, only A unit is going to comply with this concept of invoicing. So the SEZ unit's turnover will be included in the aggregate turnover, but it will not comply with the invoicing concept, right? Just a point to be noted, if I'm making a supply to a UIN holder, will it be under invoicing concept or will it be under the dynamic QR code concept? Because B2B invoicing applies, B2C the dynamic QR code applies. So just understand, very small nuance point. UIN holders are not considered as a registered person. Section 2 clause 94, the definition of the registered person, it excludes the UIN holder person. So if I'm making a supply to a UIN holder, then in that case it will be considered as kind of a B2C supply, so unregistered person, and dynamic QR code will apply, right? Not invoicing. Now in case of B2C sale to online of online money gaming, taxable service by or through ECO or OIDAR, in these three cases basically I'm linking rule number 46, that is the particulars of tax invoice, in that clause number F, and specifically proviso to rule 46 clause number F. They state a very specific important point that even if it is a B2C case, if these three kind of services are involved, then in that case, regardless of the valuation, now normally the name and state of the recipient is recorded when the value is 50,000 or more, right? But here, even if it is less than 50,000, you don't see the value, you ensure that the name of state of the recipient is recorded on the invoice, and that state will be considered as the address on record of recipient in the records of supplier. Now, if you're able to recollect this B2C case, address on record exists or not, this is interlinked with section number 12 subsection 2, that is of IGST. Section number 12 to IGST. In B2C case, you ask a critical question that whether the address exists on record of the supplier or not. If yes, that is the answer. If not, then the answer becomes the location of supplier. So what in real life people were doing, people were not recording the state of the recipient. They were not complying with this law properly. So Nirmala Sitharaman, the finance ministry, basically the government, gave a silent warning that please record the state of the recipient, and that will be the answer of place of supply. Because if you are messing up, if you're not recording it, then your place of supply is also getting it wrong. And due to that, there is a distribution of revenue that is happening, but that is wrong. So GST you are paying, but to a wrong state because the place of supply is wrong. So this was a silent warning given that please comply with it, have a suitable mechanism, devise your suitable mechanism to ensure that the name of the state of the recipient is correctly recorded on the invoice, right? Next, if it is a B2C service to a person outside India where the place of supply is India, then if the forex payment is happening, dynamic QR code is not mandatory. This is a very specific clarification, very specific pointers that we cover with respect to the dynamic QR code. So you have to learn it as it is, because logically when the person is paying in forex, he is not going to use your dynamic QR code to pay it. This is basically to encourage the digital payments. So here it will not be applicable. Next, can we amend invoicing? Answer is no, invoice cannot be amended. It can be cancelled within 24 hours provided the connected e-way bill is not active or it has not been verified, and same goes for the e-way bill. You cannot edit it. It can be cancelled within 24 hours. E-invoicing related QR code, when you scan the QR code, you get a lot of things. Amongst that, I want to stress upon 2 points. One, you do not get to see all the items. You only get to know the number of line items, and the HSN also is not available for all the items. It is available only for the main item. Main item is the highest taxable value which is involved in that particular invoice. Okay. Next, self-invoicing is relevant in case. Now this is one of the very important points to be noted. Self-invoicing is relevant in case of RCM supplies by unregistered person, and this is for the recipient to get the ITC. Please make a note of it. If it is a RCM supply and the supplier is registered, he is going to issue the invoice, not me. Okay. In RCM, the self-invoicing 31(3)(f) is applicable only and only when the supplier is unregistered. Clear? Payment voucher, that is applicable for RCM supplies, all RCM supplies. Supplier may be registered, unregistered, I don't care. Payment voucher, you need to issue, the recipient needs to issue while making the payment of the base value to the supplier, because the tax is paid directly to the government. If supplier is this, I have told you. Now, just for an understanding, what do you mean by commercial credit note? Commercial credit note or a financial credit note is a credit note without GST impact. Why without GST impact? Maybe let's say section number 15 subsection 3, the post supply discount conditions are not complied, or maybe the time limit to declare the credit note has expired. So in that case, this will be a document that we will do the in Hindi as we say hisab kitab. So basically the calculation and whatever I need to pay back to the person, I will do that, but GST will not be adjusted, output liability will not be reduced. So that is a commercial credit note. Next, records and e-way bill. We will do some important points of this chapter. Accounts of APOB are to be maintained at an APOB only. In two cases, e-way bill is mandatory regardless of the consignment value. First, interstate movement of goods by principal to job worker. Second, interstate movement of the handicraft goods by a person who is exempt from the registration. Now, this handicraft is a wide word. It kind of covers the handmade goods also, because two conditions that we cover in chapter number 8 registration, section number 23, is that the person will be exempt from the registration in these handicraft handmade goods provided he has a PAN and a mandatory e-way bill, but both are only and only applicable with respect to the interstate movement, right? Interstate transfer. Point to be noted, in a bill to ship to model, how many e-way bills are required? One e-way bill is required, can be generated by the supplier, can be generated by the third party, anyone can do, it's fine. E-way bill calculation, just point to be noted, calculation starts from the relevant date. What is the relevant date? Relevant date is when the part number B, e-way bill part number B entry is made. Now, for example, e-way bill is generated at 12:04. So technically it is 13th night, and at 12, obviously the clock will go to 14th March. So here basically the trick is that you don't have to focus upon the time. You just have to focus upon the date basically. So this is 12:04, 14 March. So my focus is on 14 March. First day will expire on 15 midnight. Okay, so 15:16 midnight will be the first day expiry. Similarly, if it is generated at 11:58 p.m., that is night of 14th March, still the answer will be same. First day expiry will be on 15 midnight. So 15:16 midnight. So you don't have to focus upon the time, you have to focus upon the date. Had this been generated 3 minutes late, that is 12:01. So technically it would have been 15th of March, and from 15th of March, my first day would have expired on 16th, 17th midnight. Is it clear? Next. Consignment value, if it exceeds 50,000, then obviously I require the e-way bill. But let's say the goods transport is happening only up to 50 kilometers of the distance. It is happening in the same state. Maybe from my place, let's say the consignor's place to the transporter's place, or transporter's place to the consignee's place, but it is not exceeding 50 kilometers. It is in the same state, not an interstate movement. Then in that case, you require e-way bill, but only part A is required. That is the basic details of the transfer and supply, not part number B. Part number B that contains the transport details are not required. Field factor is very simple. It is a short distance. It is in the state, within the state. You do not require e-way bill. Certain points to be noted: imitation jewelry and de-oiled cake, e-way bill is required. Currency, main jewelry, real jewelry, diamond, no, e-way bill is not required. If the movement is caused by defense formation, whether as a consignor or consignee, so basically it is sending or it is receiving, movement is caused by it, then in that case e-way bill is not required. If the consignor is government, any level, central, state or third local authority, and the transport is happening by rail, then e-way bill is not required. So here it is not a consignee, specifically a consignor. Small point, MCQ can be made. Stock and tax details. Sometimes a question comes that what are the two details which are not required to be maintained by a composition supplier but by a normal taxpayer? So here stock and tax details is the answer you need to quote. Three numbers you need to pay attention to. Unique enrollment number. This is only for the warehouse operator and transporter who are not registered under GST, right? So they have to file this ENR 01 and get a unique enrollment number. Now what is unique common enrollment number? This word common, what is this particular number? When a transporter is registered in more than one state, and for the generation of the e-way bill, he wants one common number. This is the number he can obtain. So this is for the e-way bill purpose for those transporters who are registered in more than one state. Is this clear? Very important. Transit number, this is for those transporters who are unregistered, again focused for e-way bill system. These three numbers you need to pay attention to. For this particular case, this unique common enrollment number, they had asked an MCQ, and in that MCQ they had also covered about the point that once this number is obtained, the person cannot use any of the existing GST. He cannot use any existing GST. I hope this is clear. Let's move to chapter number 11, that is the payment of tax. So you know, in e-cash ledger, basically PMT09 can be used for transfer of heads. Basically the balances can be transferred: major, major, minor, minor, major, minor, or minor, major. Just a point to be noted, this transfer is allowed only in e-cash ledger, not an e-credit ledger. Second point to be noted, my CGST balance of e-cash, I can transfer it to the CGST or IGST of the distinct person also. Not SGST, only CGST or IGST of the distinct person also, but provided the condition is that my unpaid liability should not be existing. So there should not be any balance in the e-liability register. Because as you say in a plane or in a flight, that before helping others, save yourself. So if there is your own liability which is pending, you cannot transfer it to the distinct person. Very important point to be noted, right? And this transfer is for e-cash ledger, not e-credit ledger. TDS return GSTR 7 is now mandatory. Pay attention to it. Earlier it was not mandatory. So nil return, if there is no deduction, you have to file. Interest, fees, late fees, penalty, all other dues, you have to mandatorily pay it via e-cash ledger because they are not output tax. ITC I can use to pay output tax. The output tax can be as a result of the proceedings also. It's fine. I can still use my ITC to pay because technically it is still an output tax. Okay. Now moving on to the next one. Section number 50, that is the interest, basically very important. Recently September 25 paper had also tested one specific part which was a little bit of a controversy, that some people had a different opinion, but we'll stick to the ICS opinion. Now basically we will take three cases. Point to be noted, please pay attention. If I'm filing my 3B late, 74A proceedings are not invoked, I will be paying my interest on which amount? The amount which I'm paying via e-cash ledger. Out of the e-cash ledger also, I will exclude that amount which is already lying in my e-cash ledger. From which date till which date? From the date of the due date of the 3B, till the date of the debit, that is when the actual 3B is filed. Because this amount technically is with the government itself. So interest is what? Interest is to compensate the late payment. So here there is no need of compensation. The amount is already lying with you. No? If it is reflected in the e-cash ledger, it means it has been given to the government. RBI has the control, government has the control. So this amount will not be taken into consideration. Next case is if the 3B is filed late but the 74A section proceedings are invoked, then you are going to be focusing on whatever the ITC is paid on gross basis. You will not be focusing on what ultimately the amount is paid by the e-cash ledger. But if any amount is lying in e-cash ledger, again right from the due date of the return till the actual debit when I'm filing the return late, then in that case that amount will not be included in your the amount for the purpose of interest. That will not be included for the purpose of interest calculation. Here there are some alternate point of views which exist, but this is confirmed as per the ICS point of view in the September 25 paper. And third case, when the 3B is filed in time but you are declaring one supply late, in that case there is no deduction on whatever the gross amount is on that particular supply which is not declared in time. Then in that case, on that particular GST amount, you are going to pay the interest. So for example, when supply was left out, whatever GST is applicable on that supply, you are going to pay interest on that amount. No deduction, nothing. This is a very simple and a direct case, right? So these are the three issues, three different circumstances which are possible with respect to the calculation of interest. Next. Now section number 50 subsection 3, very important. We talk about the wrongly availed and utilized ITC. So point to be noted is the interest is not on wrongly availed but rather wrongly availed and utilized ITC. Two questions pop up. Question number 1, how will we come to know that the wrongly availed ITC has been utilized? Because ultimately we have one ITC ledger. The correct ITC is also going there. The wrong ITC is also going there. And second, if something is triggered, if the question number 1 answer is yes, that's the wrongly availed ITC has been utilized, how much of it is utilized? Here you are simply going to compare two amounts, two ledger balances. Point number 1, this is basically the question number 1, that if the e-credit ledger balance falls below the wrongly availed ITC, this will trigger the section 50 subsection 3 interest, and whatever this difference is, this will be taken as a base for the calculation of interest. I will assume that this much ITC is utilized out of the wrongly availed ITC. There is a small derivation which goes behind it, but I don't think that this is the right time to discuss that. This is very logical, right? If your e-credit ledger balance is falling below the wrongly availed ITC, 100% it can be proved, 100% it is proved that you have utilized ITC from the wrongly availed amount. So whatever this difference is, let's say the balance is 10 and the wrongly availed ITC is, let's say, 15. So on this 5 you are going to pay interest at 18% per annum, right? With respect to TDS, section number 51, certain points to be noted. First, for the purpose of applicability of TDS, you are going to be seeing the taxable value as per the contract. If it exceeds 2,50,000, not up to 250. If it exceeds 250, on that year we will be charging, in that case we'll be charging the TDS. So TDS means the recipient is going to deduct that amount. Point number 2 you need to pay attention is a special case of no TDS. Special case of no TDS is proviso 251 subsection 1, which basically says that supplier and place of supply is in one state and recipient registration is in some other state. Now it will be a big hassle for the recipient to deduct the 1% and 1% intra TDS because that recipient is not registered in this state. So this will generally happen in the cases of immobile property. If the supplier is in, let's say, Delhi, the place of supply becomes Delhi and the recipient is of Maharashtra. So it will be very a big hassle for that recipient to take registration in Delhi is only and only for the purpose of TDS deduction. So this is a relief that no TDS will be applicable, right? Is this clear? And yes, from the calculation standpoint, one more point, that if the contract value exceeds 250 of the taxable supply, exempt you have to ignore, then the TDS actually is going to happen on the payment amount. So it is possible that a contract is, let's say, 5 lakh rupees, but the payment is 5,000. So if 5 lakh taxable value, yes, TDS is applicable. On 5,000, you have to deduct the TDS. Yes. Next, chapter number 12, TCS. TCS applicability will be only when there is one of the conditions that business model condition test should pass. That is, ECO should be receiving the payment and then he should be discharging the payment to the supplier. Here the deduction of commission and TCS will happen. The rate is 0.5% or 0.25 plus 0.25%. Services through ECO, basically in case of services, there is a line to be learned, there is a conclusion to be learned. That if I am supplying services, it can be inter, it can be intra, it is through ECO. In all cases, the registration threshold I will be getting 10 lakh or 20 lakh. Passenger transport, if it is happening via omnibus, then here with respect to 9.5, 9.5, it's a deeming provision, notified supplies. We assume that the ECO is the supplier, right? So if it is a case of transportation of passenger via omnibus, see what is the status of the supplier. If the supplier is a company, then it is not covered under 9.5. If it is not covered under 9.5, then TCS is applicable if supplier is registered. If supplier is registered. Okay. And just a point to be noted, specified premises that we use in the restaurant services, basically that restaurant other than specified is covered under 9.5. So specified premises means your room tariff for any unit of accommodation is more than 7,500 per day, more than. Okay. Now with respect to the registration requirements, if there is a supplier of goods through ECO, if he is making interstate supply, then mandatory registration. If he is making intrastate supply, there are certain conditions to be complied, like for example, interstate supply is not allowed, validation of PAN is required, enrollment number needs to be obtained, he should not be operating from more than one state. If all those conditions are complied, then he will be getting his registration threshold and mandatory registration section 24 will not apply. Composition supplier, just a point to be noted that supply of goods by composition supplier through ECO is permitted subject to certain conditions. Again, TCS will be applicable, reporting will happen in GSTR rate by the ECO and all those points will apply. Correct? Next. Section number 9.5, basically the notified services, accommodation and housekeeping and plumbing, basically the entry, these two entries will be covered under 9.5. These two transactions will be covered under 9.5 except when the supplier is liable to be registered under section 22. Actually registered or not registered, I don't care. Section 24 mandatory registration, no, I'm not talking about that. Liability to register under section 22 means I'm talking about the turnover threshold. Is it clear? Next. Chapter number 13, certain points to be noted. GSTR 1A filing will be only after you file GSTR 1 and before the filing of the 3B, and you cannot revise any earlier period's data. Right? GSTR 1A only for that particular period. Another point I remember that you can stress upon is if you want to change the recipient's GSTIN, if you want to amend the recipient's GSTIN, that cannot happen via GSTR 1A. That will happen via amendment table in your next GSTR 1. Okay. Okay, done. GSTR 1, basically the consolidation limits you apply, but there was a change not in this particular attempt but rather 2 attempts before, that for B2C supplies, if it is an interstate supply and if it is more than 1 lakh, earlier this limit was 250, if it is more than 1 lakh, then in that case you need to disclose it individually, no consolidation, right? So earlier this limit was 250. If you're using any earlier book, then please ensure you are updating this. And similar thing exists for the revised tax invoices. There the limit is 250 only. IFF is not mandatory. This is for the QRMP people, M1 and M2. IFF is not mandatory. You cannot file it late. And this is only for the first 2 months of the quarter under QRMP scheme for the recipients to get the ITC. And yes, there is a limit as to how much you can declare in the IFF. So that is 50 lakh taxable supply in each month M1 and M2. Okay, so if it is more than 50 lakh, you have to decide to whom you want to pass on the ITC. If a person is not required to file 3B, he is not required to file GSTR 10. This is a very important point to be noted. GSTR 10, you have to file it within 3 months from the cancellation order or effective date of cancellation, whichever is later. But another condition is that the person should be required to file GSTR 3B. So the ISD people, NRTP people, TDS deductor, TCS collector, OIDAR supply from outside India to NTOR, all these people get excluded from this list. So they don't have to file GSTR 10 if cancellation happens. GSTR 4 for composition supplier, the due date is now 30th June, not 30th April. Earlier it used to be 30th of April. GSTR 5A, just a point to be noted, it will also contain the details of OIDAR supplier from outside India to a registered person. Although this is covered under RCM, but this is just for the reporting check and also kind of checking whether the recipient is complying under RCM or not. Now you might have a query that if the supplier is making only the supplies, let's say I'm an OIDAR supplier from outside India and my only supplies are to the registered person, then obviously I won't be a registered person. I won't take registration in India and then GST 5A will not apply. But if some supplies are to, let's say, NTOR and I have taken a registration, then in my GST 5A, I also have to ensure that I disclose these transactions, right? For QRMP, to exercise QRMP or to opt out of QRMP, there is a certain time limit. How does it work? For any given quarter with respect to which you want to go under QRMP or you want to opt out of QRMP, then the time limit is first day of the second month of the quarter which is the preceding one till the last day of the first month of the relevant quarter. So simple example we'll take, let's say October, November, December. So whatever the timeline for opting or exercising out of this QRMP will be last month quarter. What is last month quarter? July, August, September. August, first day you will pick 1st August till 31st of October. Now it's very logical. So why till 31st October? Because if I do not tell government by 31st October, otherwise see, the government is going to expect your monthly return. So by 31st October, I will tell government that please don't wait for my monthly return. I'm going to go under the QRMP scheme. Similarly, for the last quarter, July will go in the April, basically the July, August and September related filing. So similarly, 31st July gone, in current October, November, December, the option will be till 31st of October. Hence, the derivation that it will run from 1st August to 31st of October. Yes, in annual return question, if they ask you with respect to the GSTR 9, you don't forget to quote about the exemption with respect to those who are required to get their accounts audited by the CAG or any auditor appointed by them, or for the local authority, there is a provision that local authority may be required to get their accounts audited under their own law. So this is an exemption. They don't have to file annual return. They don't have to file any RICO statement. Right, reconciliation. Then chapter number 14, import export under GST. Just a point to be noted, merchant export, the rate of GST is 0.1%. This is a beneficial rate. This comes with a set of conditions. Out of the conditions, 2 are very testable. Point number 1, when that merchant exporter, now what is a merchant exporter? This is a manufacturer and seller. He sells it to a merchant exporter and he ultimately exports it. So the 2 points to be noted here, this export cannot happen under payment of IGST route, LUT route or bond route is mandatory. And second, this needs to happen within 90 days from the issue of the tax invoice in which the 0.1% GST is applied, right? Next, whenever SEZ developer or SEZ unit is involved in any transaction, it is always an interstate supply. Specific law will always prevail over general law. So let's say accommodation service given to SEZ developer, technically by general law, it can be a interstate supply, but no, here specific law, it will always be an interstate supply. What is the difference of bond versus LUT? As we write LUT come bond. So in bond, the additional point is the burden of getting a bank guarantee. 15% of the amount you need to have a bank guarantee. So this is a hassle compared to LUT. Mohit Mineral case law, you have to quote whenever the question number 1, like question number 1 or maybe some adjustment question can come in which there is an ocean freight involved. With respect to the import of goods transaction, so here basically on this ocean freight, there will not be again any implication of GST on RCM basis under the GST law. So what is this concept? This ocean freight is added to the valuation of goods on which I pay IGST on the import of goods under the customs law, right? as we cover in our chapter of valuation in the customs. So that amount will not be again taxed under GST as an import of service that supplier is outside India, recipient is in India. No, the double taxation will not happen. For that, you have to quote up this particular case law, that Mohit Minerals case law has concluded this, that there will not be again any GST implication under the GST law. Okay, this is clear, right? So this is your chapter number 14, and yes, so let's move to chapter number 15. Rule number 89.4, 89.5, ensure that you are doing this correctly. You're doing this properly along with the question. Numerical can be asked. 89.4 is your when you're using the LUT route, and 89.5 is your refund of ITC in case of inverted duty structure. These are the only two cases where you get the refund of ITC, right? Here the denominator is the adjusted total turnover. Please do not include the exempt turnover unless it's zero rated. If a supply is exempt and it is exported, it acquires the nature of export, it acquires the nature of zero rated. In that case, it will be included. If only exempt, it is not to be included, because whatever the calculations and reversals for exempt turnover, exempt supply, they happen in rule number 42. So here they will not be included in the denominator. So this is a benefit for us. Okay. Next. E-credit ledger refund claim is rejected. Re-credit in e-credit ledger. Now, this is a very, I would say, a very good small point which is sometimes asked in the exam. Just understand one thing. When you file for the refund application, you debit the corresponding ledger. So if I'm asking for the ITC refund, I will have to debit my e-credit ledger when I'm filing the RFD01 application. If that application is rejected, my e-credit ledger will be recredited, because basically I'm expecting that money in my bank account. So my one asset has to be reduced. So that asset of e-credit ledger on the portal has to be reduced, because I'm expecting another asset, that is cash in bank. Right? But if the application is rejected, the e-credit ledger is recredited. Now this concept, this particular recredit is going to happen in which case? That is important to understand. When I go under the LUT route, the e-credit ledger is not utilized because I'm not paying IGST on export. In that case, I go for the refund of e-credit ledger under rule 89.4. If this application is rejected, then the recredit will happen. But if I'm paying my IGST on export, then whatever the e-credit is, I'm going to be utilizing it while paying the IGST. Hence, when I'm filing for the refund application, I'm not asking for the refund of the e-credit ledger. I'm asking for the refund of the IGST paid. So here, in this case, when I have gone under the route of payment of IGST and my application is rejected, there will be no recredit of the e-credit ledger. I hope you are able to understand this. This is a very small important point, sometimes asked in the exam. Okay? Yes. Next, rule 89.4, whenever the goods are exported under LUT bond, one is the bookish calculation, that is we do as per the formula. Please don't forget to check the three limits for actual amount of the refund, actual amount that will be refundable. That is the calculation as per rule 89.4. Balance in e-credit ledger at the end of the period after 3B is filed, and balance in the e-credit ledger when you actually file the RFD01 application, because you again have 2 years for that. So lowest of the three is the actual amount of refund that you will be getting, and this you have to debit from the e-credit ledger in the priority of first IGST and next CGST, SGST equally. If one of them is not sufficient, then whatever the balance is, that shortfall will be debited from the other head of the account, e-credit ledger. Okay. Next, there are certain goods which are notified for the purpose of non-eligibility of refund under rule 89.5, that is the inverted duty structure. Now, question comes that first of all, this will be given in the question, so don't worry, we don't have to learn a list. But if such good which is notified for the purpose of no refund under 89.5 is tomorrow exported, can I get refund under 89.4? Answer is yes. 89.5 you are not allowed, but that same notified item is exported, I can get refund under 89.4, obviously if I am going under the LUT route. Net ITC in our 89.4, the net ITC calculation that we take, it includes input and input services in 89.4. In 89.5 it only includes inputs. Capital goods, nowhere it is included. Minimum refund claim under each head is rupees 1000, and this is not applicable for e-cash ledger. 2 years time limit for RFD01 is also not applicable for the e-cash ledger. Okay, next. CSD refund, that is the canteen stores department, they get the refund of 50% of inputs, not services and capital goods, inputs. Next point is a circular clarification regarding how to adjust the tax liability. If advance is received and invoice is also issued, then if the GST is paid, obviously it will be paid because I have also issued the invoice. Had the invoice not been issued, then only we will be talking about services, because advance on goods, the GST is not applicable. And later on the supply is cancelled. Now how to adjust the liability against the government? I have paid in excess, right? The supply is cancelled. So my priority number 1 will be to adjust it via credit note. If there is no output tax liability, or let's say the time limit is exceeded, or whatever it may be, credit note route cannot be taken, then I will be filing for the refund application RFD01 and I will be claiming the refund from the government. And the head I would be using, basically the reason for the refund would be excess payment of tax, if any. If GST is paid on advance and invoice is not issued, so this would be only in case of service, because in goods, as I said, there is no GST on advance, then directly I will have to go for refund application. Why? Because credit note, debit note, these concepts and these documents are relevant only if invoice is issued first. Okay, so if there is no invoice, there is no point of credit note and debit note. Chapter number 16, job work. Just a point to be noted, whenever any practical question is asked, the first opening line you should be giving is that what is the meaning of job work. That is basically you are doing some treatment process on goods belonging to others. Second, you have to write that as per schedule number 2 of CGST, this is a supply of service. So the service rate you have to apply. Point number 3 to be noted, if there are any goods used in the process, still this would be kind of a composite supply where the principal element is the supply of service, and you would be using as per schedule number 2. Obviously, this is a supply of service. You are going to apply the rate of GST of services, not goods. Okay, next. Chapter number 17, assessment and audit. Certain points to be noted. In section number 64, from that point of view, that is the summary assessment. They sometimes ask that is it necessary that the order is passed against the taxable person? No. There is one special case in which the taxable person is not ascertainable. In case of goods, whoever is the person in charge, for example, the warehouse operator, he will be considered as the deemed taxable person and he would be liable to pay the GST. You have to mention this in the answer also. And if this is asked specifically, then obviously you will be able to click. But if not asked specifically, only there is a general note on 64, don't forget to write it. Sometimes there is a question asked that what are the two cases where the withdrawal of assessment order is done. So that is 62 and 64. 62 is the best judgment assessment of non-filers. 64 is the summary assessment. In both the cases, there is a withdrawal provision. In section number 62, if you file the return within 60 days plus additional 60 days. So initial 60 days is given, additional 60 days is given for further rupees 100 per day penalty and the late fee, sorry, we will not use the word penalty, late fee. Then in that case, the withdrawal of assessment order will be done. And in 64, there are two cases. Assistant Commissioner, Deputy Commissioner, either they feel suo moto that the order is erroneous, they can withdraw the order, or the person can make an application within 30 days of receipt of order that, please withdraw this and let's go for the normal assessment. Why to go for the summary assessment? So in two cases, you have to talk about 62 and 64. Just a point to be noted, 62, non-filer. Which returns are not filed? As a consequence of which section 62 applies. So that is your two returns, GSTR 3B and GSTR 10. GSTR 3B and GSTR 10. That is basically the final return. You will get this corrected in the PDF, don't worry. Okay, so this is done. Section 65 and 66 deal with the audit provision. Section 65 audit time limit is 3 months plus extension of up to 6 months by the commissioner. Section number 66, that is the special audit. Certain points to be noted. Here the time limit is 90 days plus another extension of 90 days. So time limits are different. Now, more points to be noted. Special audit is never the first step in itself, meaning which it cannot be the case that there is no proceeding pending against me and the PO wants to go for the special audit. No, it is not possible like that. He has to, there needs to be some inquiry, some proceedings pending, and then the special audit can be done. This similar point applies for summons also, and this similar point applies for the attachment, provisional attachment also. Okay, next. Order for the special audit is given by the assistant commissioner or above, and that too with the prior approval of the commissioner. Next, the reason for special audit is seeing the nature and complexity of the case. These are the two keywords. Either the value is not correct or the ITC taken is not within the normal limit. If there is some other reason given in the question, for example, the rate is wrong, the GST rates are picked wrong, that cannot be the reason for special audit. This was asked in the IBS as well. Next, chapter number 18, inspection, search, seizure. All the approvals in this chapter are given by JC or above, Joint Commissioner or above, except arrest where the Commissioner's approval is required. Just a point to be noted, please learn the specific reasons for inspection, search and goods liable for confiscation, section 130. This is just I'm mentioning. There is no any mistake pointer possible. Those are plain direct topics, sometimes asked directly in question number 5. So I want you to write it properly rather than just giving vague answers. Okay, next, chapter number 90, demand and recovery. Let's start. Fundamental rule of 74A demand is there should be a supply. So for example, if the offense is invoice without supply, 74A demand is not possible. Yes, it is a punishable thing. It is a punishable act, but that will be under 122 then. 74A demand only when there is a supply. Okay, so if there is a supply, then only there is a tax, and then only that there can be a demand of tax along with the related interest and penalty. Non-payment of self-assessed tax and non-payment of amount collected in the name of tax. Okay, these are the two offenses. If you do not pay these two amounts within 30 days of the due date, in that case, you are not going to get the penalty waiver. Now, there are certain query areas here. Please understand. Demand proceedings have to be invoked. That is, a show cause notice is required for levy of penalty. Tax interest, direct recovery is possible. But for penalty, there needs to be a show cause notice. Once the show cause notice is there, then this will be in application by saying, I'm repeating this point, that these two amounts, if you do not pay within 30 days from the due date, and let's say after 2 months, there is a show cause notice issued for demand related penalty, then you cannot get any penalty waiver. Like in non-fraud case, you get the penalty waiver of paying before the show cause notice within 60 days of show cause notice. In fraudulent, you get 3 penalty waivers. Those you are not going to get. Once 30 days from due date is crossed and the penalty is invoked, demand proceedings are invoked, 100% for surety, you are going to be levied the penalty. Is it clear? Okay. Section number 76, that is tax collected but not deposited to the government. There is no time limit for issue of the show cause notice. Yes, there is a time limit for issue of the order, that is 1 year from the show cause notice issue, but there is no time limit for the issue of show cause notice. Clear? And another point to be noted here in 76, the interest is applicable from the date you collected the amount. Obviously, as we know, ICI takes from the next date itself, but still the point to be noted here is you are not going to see the due date of 3B. You are going to be seeing when the amount is collected that the person did not pay. Section number 80, monthly installments, maximum 24 installments are allowed. 2 areas out of 3-4, 2 areas where the mistake happens, that self-assessment, this tax installment is not allowed in 2 cases. Point number 1, for self-assessed tax. See, what do you mean by self-assessed tax? Self-assessed tax means basically that you are declaring your liability. So this includes the amount that has gone in your GSTR1 but not paid via 3B. Okay, so not allowed for self-assessed tax and not allowed where the amount of tax is less than 25,000. So up to 24,999, you are not going to get the installment facility. You need to pay the tax in whatever the complete amount you need to pay as per the time limit, right? That you know in section 79, 3 months you have to pay, otherwise recovery provisions will apply. Chapter number 21, offenses and penalties. One of the offenses that we covered is 132(1)(d) in the criminal prosecution, as well as in 122(1), that there is a default in payment of tax. Now, this particular default in payment of tax will be covered under 122, will be covered under 132 only when this default is more than 3 months. If nothing is given, put an assumption that I'm assuming that this delay is beyond 3 months, and hence we are applying the provisions of penalty. No penalty for minor breach. Minor breach means the total tax involvement is less than 5,000, is equal to 5,000. It is not a minor breach, penalty is possible. This was asked in the MCQ. So 4,999. Till this point, no penalty. So this is somewhat similar to like the charitable limits we covered, 999, 9,999. So these things we can cover. Arrest has to be with the sanction of the commissioner. Now, arrest, we have couple of the offenses that we have learned along with the limits. So the basic limit is more than 2 CR. Okay, more than 2 CR. There is only one offense for which there is a lower limit, that is invoice without supply or bill of supply without actual supply. And that for there the limit is more than 1 CR up to 2 CR. But all other offenses, 132(1)(a), invoice, the supply without invoice, fraudulent ITC, everywhere there has to be more than 2 CR involvement. So 2 CR to 5 CR and more than 5 CR, accordingly the penal provisions apply. Next is your cognizable offenses. What is cognizable offenses? These are basically non-bailable, means bail is not given as a matter of right. So here 4 offenses you have to learn. SAF means supply without invoice. Pay attention. You have to learn it. Supply without invoice, invoice without supply, amount collected but not paid to the government beyond 3 months, and fraudulent ITC. If it is more than 5 CR, then it becomes a cognizable offense. So bail not as a matter of right. Basically, you can write it as non-bailable, and without arrest warrant, the arrest can happen. All those things will apply here, but only when the amount is more than 5 CR. Is it clear? Okay. For every second and subsequent offense under section 132, don't see the amount. Once you are convicted in any offense, and if you are convicted again, then in that case, your highest level of punishment will apply, that is up to 5 years imprisonment and fine. Please do not use the word penalty when we are talking about 132 criminal prosecution. Use the word fine, and there is no limit here. Court will decide. Okay. and everywhere minimum 6 months imprisonment is also there, unless there are some special or adequate reasons to be recorded otherwise. Now with respect to compounding, certain points to be noted. 132(1)(b), that is the offense of invoice without supply, no compounding possible. All other offenses also compounding possible only once in your life, and if you are convicted, that is final order is there that you are guilty, compounding is not possible. Sir, can I go for the compounding even after the institution of prosecution proceedings? Answer is yes. Conviction order should not be there, right? Is it clear? And compounding, basically what is the benefit of compounding? I will get the immunity from the imprisonment. Next, chapter number 22, appeals and revision. If the appeal is filed to the appellate authority with respect to 129(3) order, this is with respect to the offenses in transit, contravention of law, the owner comes forward, does not come forward, that particular order. Here there is no tax involved, only penalties involved. So special limit you need to learn that if an appeal is filed to the appellate authority against 129(3) order, the pre-deposit is 25% of the penalty amount. Who will be the appellate authority and who will be the revisionary authority? Please learn this point. It has been asked in the exam, can be asked in the MCQ as well. Who will be the appellate authority? If the order is passed by the additional commissioner or joint commissioner. So the basic hierarchy we follow is commissioner, additional commissioner, joint commissioner, deputy commissioner, and assistant commissioner. This is the basic hierarchy we follow. Now pay attention. Additional and joint. So sometimes depending, one of them is appointed or both of them are appointed. Who is above them? Commissioner. So you will write commissioner and bracket appeals. Why? Because this is the appellate authority wing. So GST department has various wings. Execution, that is the field officers, audit commissionerates, appellate authority wing. So we are talking about appellate authority right now. So we'll write in the bracket appeals. If the order is by the deputy or assistant commissioner or below that superintendent, this is the first level above. So not below the rank of JC appeals. Now with respect to RA, who will be the RA? If the order is by the additional or joint commissioner, the RA is basically the senior officer, will be the principal commissioner or commissioner. Now here please don't write the word appeals in the bracket because this is the senior officer in the same wing, not of the appellate authority wing, right? And next, if the order is by the deputy assistant or superintendent, above additional or joint commissioner. Okay, so this chart can help you to learn these limits. Now a point to be noted, in section 108, basically the revision is happening. What is the revision? The order passed by my subordinate officer is erroneous, right? So when I am correcting that particular original order, I have certain record with me. Now what do you mean by record? Record means whatever information is available at the time when I am doing the examination. Not necessarily, it is not necessary that that information should be available at the time of the original order. So let's say the original order is of January, I am doing the revision, I am the senior officer, I am doing the revision in the month of November. So record may be something which was let's say a Supreme Court order or some observations of the Comptroller Auditor General of India which were passed in October. I can still use that for the purpose of revision when I am doing in the month of November. The person cannot say that no sir, these orders and this particular observation was not in existence when the original order was passed. No, it doesn't have to work that way. Next, appellate authority cannot refer back the case to the adjudicating authority. Tribunal can. Appellate authority has to rectify the mistake itself. Either it will confirm, modify or annul the order. It cannot refer back for the fresh adjudication. 108 revision order. These are two sentences which are part of the fetters, the topic of fetters of revision, that is the restrictions. So the 2 points to be noted here is that order which is revised, it can be revised only once, and revision order cannot be revised. So let's say there is an order passed by my junior. I can revise this only once, and this revision order cannot be again revised. So here there is often a confusion that, sir, is it talking about the same thing? No. The original order which I want to revise, I can do it once, and my revision order cannot be revised by me. Me means not by anyone, like no one can revise that order, neither me nor anyone else. Is this clear? Okay. Just a point to be noted, section number 121, that heading is non-appealable orders. What are the 4 orders covered there? RTP 80 is the short form that we learn. RTP 80. So what is this? The order with respect to the retention of the books, the order with respect to the transfer of proceedings, the order of launching the prosecution, and section number 80 is the installment system, basically, the allowing the tax to be paid in installment. These 4 orders cannot be appealed. Along with that, make a note of it that these 4 orders cannot be even revised under section 108. If you want to verify this, go in section number 108, see the Bare Act that is subject to 121. So these cannot be appealed, these can also not be revised. I hope this is clear, because this is a point which is missed out a lot of times. Next is the point of partial integration, which is confirmed in section 108 RA. Now again, one of the features is that the revisionary authority cannot act on any order which is appealed. So basically, out of the appeal also, the RA cannot revise that particular matter which is raised and decided, in that particular appeal. Raised and decided. So basically, if something is raised but not decided, or it is not raised at all, let's say there are 2 matters out of the order which were not raised, or they were raised but not decided, the RA can still act against on that particular order against these matters. He can revise that. But what is the time limit? The original time limit, that is till 3 years, that is the expiry of 3 years, or 1 year from the date of order in appeal, whichever is later. So basically, he has to wait for the order in appeal, see what all matters were raised and decided. So we will give 1 year from that time as well. So we will compare that 1 year from the date of order in appeal with 3 years from the original order, whichever is later. Is this clear? What is the basic time limit? 6 months should have expired and 3 years should not have expired. What is the logic of 6 months? Because till 6 months, the department can go for an appeal. Section 107, Appellate Authority. In tribunal, there is a concept of single member bench that is possible when 3 conditions are complied. The amount of tax penalty, whatever is involved, is not crossing 50 lakhs. Second, it is a question of fact, not a question of law. Question of fact means, for example, return was filed or not, something was done or not. Question of law is some interpretation involved, legal analysis. And third, you need the precedent approval. Appellate tribunal, we can say that it is a final fact-finding authority, because appeal to High Court, Supreme Court can be filed only upon a question of law. Now, with respect to appeal to the tribunal, department also has the condonation of delay, that is 3 months provision is there. Earlier, the condonation of delay was not allowed to the department, right? Now, there is a concept of pre-deposit that we will see what are the limits. When the pre-deposit is refunded, let's say I win the case, then I will get the refund of the pre-deposit along with the interest. This interest rate you have to take as 9%, not 6%. And this interest will start from the date you deposited the amount, but ICI will take from the next day. You know the reason, right? We have covered this in the questions. You must have covered it in the questions, that from date, the first date we exclude. And another point to be noted, a mistake area here is that self-admitted liability that you are depositing, you're not going to get the refund of that. So if, let's say, there is a total pre-deposit of, let's say, 15 CR, out of which 5 CR was self-admitted. So balance 10 CR, that would have been 10% of the disputed tax, that you will get the refund along with interest. So interest calculation will be on that portion, not the self-admitted liability. Appeal to the High Court and appeal to the Supreme Court. Appeal to the High Court will be against the order of state bench of the tribunal, and it should involve some substantial question of law. What do you mean by substantial? That impacts the rights obligations of the parties. Appeal to Supreme Court will be against the order of High Court or against the order of principal bench of the tribunal. So if the order is passed by the principal bench of the tribunal, you do not go to the High Court, you directly go to the Supreme Court, and obviously it should also involve some substantial question of law. A part they can ask here is with respect to the place of supply, with respect to the matter of anti-profiteering. These 2 issues are 100%, they are for sure dealt by the principal bench of the tribunal. So you should be knowing this. Question may not give you the bench status. So here it will be the principal bench against which the order will be passed. If the order is passed, and against which the appeal will be filed to the Supreme Court, not the High Court. Another point to be noted, if I want to go against the order of High Court and I want to appeal to the Supreme Court, it needs to be certified as fit for appeal. High Court can certify it suo motu, or I can get it certified by way of filing application. Is it clear? No such certification is required against the order of principal bench. Pre-deposit limits, something that you cannot miss, very important. When you are going for an appeal to the appellate authority, admitted liability plus 10% of the GST in dispute. GST in dispute subject to 20 CR. I am talking about the CGST right now. IGST, it will be 40 CR. And when I am going to the appellate tribunal, whatever is my admitted liability, that will go in addition. So this actually in addition will be for this particular disputed amount. But in paper, please write it again. People ask that, sir, why will I deposit admitted liability again? You have to write it like this in the paper. So admitted liability plus 10% of the GST in dispute, again in addition, subject to another 20 CR. Clear? Now the limits are very easy to learn. IGST, this 20 CR will be 40 CR. Another mistake area, self-admitted. When I'm using the word liability. So this includes tax, interest, penalty. but here I'm only using the word tax. Next, section number 120, there are certain departmental appeal monetary limits. Monetary limit means with the unless and until the case involves that much amount, the department cannot go for an appeal. So for tribunal, high court and supreme court, the limits are 20 lakhs, 1 CR and 2 CR. Below that, the department cannot go for an appeal. Now, what are the amounts that we compare? Like 20 lakhs, what we have to see? The entire amount in the order, or how come what you are going to compare? So see, if tax is there along with interest penalty, I will ignore interest penalty, I will see the tax amount. If tax is not there, interest is there, penalty is there, or interest plus penalty is there, whatever these amounts are, you will see this. And if it's a composite order, you see the total amount involved, like total of all the orders, not individually. Is it clear? There are certain cases where this limit is not applicable. One of the important provision here is PCRV chapters. So place of supply, classification, refund and valuation. These four areas, these four matters, this limit will not apply. So the department can go for an appeal regardless the amount may not be crossing these limits. This was also asked in the exam. Okay. Advance ruling. To obtain the advance ruling, the person should be just an applicant desirous of getting the advance ruling, may or may not be registered in GST. Authority of advance ruling, the minimum rank is JC. Another point you can note here is whenever you are talking about authority of advance ruling, please use the word application. Please use the word application. And whenever you are filing an appeal to the appellate authority for advance ruling, please use the word appeal. Okay, small differences, but it makes an impact. Miscellaneous provisions, obviously we don't cover this chapter, so I'm not put a lot of points here, just certain things that power to make rules is given to the government and power to make regulations is given to the CBIC. Okay, let's proceed. Let's move to the customs part now. Let's see. Chapter number 1, levy and exemption and the definition parts. The constitutional power to charge the customs duty along with the other provisions, you have to talk about entry number 83, the union list, that is the exclusive power given to the parliament. This needs to be highlighted in your paper. Okay. Next, goods exported for repairs abroad and re-imported. Now, obviously, section number 20 with the concession table, it is important. Concession table number 1, I'm talking about the export for repairs and then it is coming back. The concession table that you get, the concession that you get is basically instead of charging the duty again on the value, the duty is charged only on the fair value of the repairs. Fair value means actual incurring, actual payment may not be there, but the fair value of repair including the material cost, insurance and freight to and fro, correct? On that the import duty is charged, but that concession is applicable only when that machine is coming back. In one of the questions they had mentioned that a replacement machine is being sent. So in that case there is no concession, you have to apply the duty on the complete cost of the machine. IGCR, just a point to be noted here that IGCR is being tested a lot recently. In last 3-4 attempts, they have tested a lot of things, especially with the point of view of the depreciation and calculation of the duty. Certain changes recently that took place. Earlier, it was a monthly statement, monthly report basically, which was filed with the authority. But now it is quarterly reporting. Next, the goods can be sent to a job worker. Earlier, it was 6 months time limit. Now it is 1 year. Next, re-export of unutilized or defective goods. So you can re-export it, but what is the timeline? Now timeline, I have seen students directly quoting the part of 1 year. No, before that you have to write that the timeline and this time is as per the original notification which is asking us to refer the IGCR rules. If nothing is there, then the time limit is 1 year. Okay, is it clear? Next, now certain periods covered with respect to the cluster of 13, 23 and 22. 22 also have covered here. So 13, 23, 22 are extremely important, very important for you to cover. 13 is pilferage, 23 is the LAD, lost, abandonment and destroyed, and 22 is the abatement on deteriorated and damaged goods. Section number 13 does not cover the warehouse goods. It is only till the order is given by the PO for warehousing or for clearance of the goods. Section number 23, lost and destroyed, it covers the warehouse goods as well. So warehouse goods also, if they are lost or destroyed, then section 23 will apply and the duty will be remitted. Okay, so anytime before clearance for home consumption is there in 23. Now abandonment, that is the relinquishment of the title of the goods, that has to happen again before the PO's order is there for putting the goods into the warehouse or for clearance of home consumption. So the abandonment part does not cover the warehouse goods. It does not cover the warehouse goods. But sir, then can we conclude that the warehouse goods cannot be abandoned? No, we cannot conclude that because this power abandonment is given not under 23 but section number 68, that is the warehousing chapter. Is it clear? Next. Section number 22, damage and deterioration, very, very important. There are three clauses, A, B, and C. A covers damage and deteriorated both, that is before or during unloading. Then after unloading and before examination in B, and in C, warehouse goods, only damage word is used. So if they put the point that the goods are deteriorated after unloading and before examination, you are not going to get the benefit of abatement. What is abatement? Basically, whatever the fall in the value of the assessable value, basically how much, whatever the fall is in the value of the goods, that much the duty will also proportionately reduce, right? This is the case of abatement of duty. In B, I'm just repeating the part. In B, it is after unloading and before examination. Okay, before examination. After examination, then you will not get the benefit. Minimum customs duty payable is 101. Minimum customs refund is rupees 100. Up to 100, no custom duty is payable. There is no such minimum GST payable. GST refund minimum 1000 in each ledger, in each head of your ledger. Okay. Certain points to be noted from the definitions part. Indian customs water, it extends up to the exclusive economic zone. Maximum depth of the sea water in the continental shelf is 200 meters. And the stores definition is not applicable for vehicle. It is only for a vessel and an aircraft. What are stores? These are not exactly imported, exported, but they are the items for use and emergency, like for example, food, fuel, or some spare part. These are the points from the definition which can be asked in some valid, invalid statement form, or a correct, incorrect, or some form of a MCQ. It is possible. Next. Chapter number 2, types of duties. Safeguard duty 8B, it is possible on a provisional basis, but max to max 200 days. When we talk about section number 9 and section number 9A, that is subsidy and anti-dumping duty, there is no time limit with respect to the provisional measures. Now, with respect to the exemptions where the safeguard measures do not apply, no safeguard duty if you are importing from a developing country and the share of the import, it does not exceed 3% of the total import. So here it is up to 3% allowed if you are importing from one single developing country. If you are importing from more than one developing country, individually it should be less than 3 and the total should not exceed 9. So here it is individually less than 3, not up to 3, and total it should not exceed 9 of the total imports of that particular item in India. Clear? Subsidy, CVD, section number 9, and anti-dumping duty. Retrospective is possible. This is not possible in safeguard, but here retrospective is possible, and here the maximum time limit, maximum in past I can go is 90 days from the notification. Anti-dumping duty calculation can be asked in the MCQ as well. You have to calculate two amounts, dumping margin and injury margin, and you have to pick the lower of the two. Dumping margin means normal value minus the export value, and injury margin is non-injurious price minus the landed value. Now just a point to be noted, this landed value is calculated from the export price only. That export price plus basic customs duty becomes the landed value. Okay, and this is the non-injurious price, that is the normal value in the Indian domestic market. Next. Anti-circumvention measures, if we find that the person is taking anti-circumvention measures, basically he is circumventing and we are taking anti-circumvention measures. So how come he can avoid this duty by changing the name, description, form, country? Then in that case, we can extend our duty to the changed and altered form as well. But that imposition cannot be from earlier than the date of initiation of inquiry. This can be asked in the exam. I am like, most probably people will miss out on this, but do ensure that you're noting this point, that anti-circumvention measures cannot be earlier than the date of initiation of inquiry. Okay, not notification, initiation of inquiry. Section number 8 and 8A that deal with the emergency powers to impose or enhance the import duty and export duty, right? So basically export duty is 8 and 8A is import duty. So here there are two differences when we cover 8A and we compare it with section number 8, that is with respect to import duty. When we see in 8A, there are two differences. First, the good should be specified in the first schedule. This is not mentioned for export duty. Export duty may or may not be specified in the second schedule. And 8A, there is another condition attached that earlier notification of 8A should be placed before the parliament and it should have been passed. With or without modification, I don't care, but it should have been passed. This condition does not exist when I see section number 8, that is export duty related imposition or enhancement. Section number 3, subsection 8A, that is you compare the value of warehouse goods. If you remember, the assessable value or the last transaction value, whichever is higher, that calculation is done only and only for the purpose of computing IGST, not for the purpose of basic customs duty. Okay, next. In classification, obviously, this is a very straightforward chapter, but 2 points I want to stress upon. In the project import, you can import the spare parts and consumables and raw material, but there is a limit. Total 10%. Totals 10% can be, maximum 10% can be this import. And second, if there is any individual exemption notification out of the complete project import, I will get the benefit of that exemption. Supreme Court has ruled it. Chapter number 4, valuation. The most important part is picking the dates and picking the rates. Which dates BCD you have to pick, which dates exchange rate you have to pick. So this is a quick coverage of that, because if you commit an error in this, your answer is not going to match, you will not get marks. So see, when we talk about home consumption, the BCD rate I want is fresh. In Hindi we say taza taza, means fresh rate I want. So here you will apply that field factor and learn that the date you will be picking for the BCD is the date of presentation of bill of entry or the date of arrival in case of vessel or aircraft, or in not vessel, sorry, in case of aircraft or land, that is a vehicle, and in case of vessel you will be picking the entry inwards. See, entry inwards as a procedure is only and only applicable for a vessel. So for land, vehicle and aircraft you will see arrival date. For vessel you will see the date of entry inwards. Okay, so that's why I've written both. Arrival, that will be applicable with respect to land and aircraft, that is vehicle and aircraft, and entry inwards will be applicable in case of vessel. So if it is a case of advance filing of bill of entry, I will have to pick this date. And BCD rate in case of warehousing, so they were put into warehousing and now they are being cleared, so I want the fresh rate. I will pick the rate on the date when the ex-bonding bill of entry is filed. Rate of exchange, first of all I have to take off the CBIC. They will give you the rate of RBI, they will give you some other rate. No, you have to ignore that. You will be picking the rate of the CBIC and which date. If it is a case of home consumption, here I don't have to see fresh or anything, just the original filing that is done, the main document that you file, that is the bill of entry. So in case of home consumption, you take the bill of entry even if it is filed in advance. In case of warehousing, you see the original into bond bill of entry, not the ex bond. You see the into bond bill of entry is filed, that date's rate of exchange you will be picking. Next, buying commission, you always have to exclude it. Sometimes they will write the word commission, but they are not stating it explicitly whether it is a buying commission or it is a seller's commission. So in that case, if they have mentioned that commission is paid to an agent in India, you assume it as a seller's agent and seller's commission, and you have to add it. Because see, if I'm a buyer, I'm the importer, my agent would be outside India and I would be paying in the foreign currency. So this assumption only when they have not stated it explicitly, right? So if it is paid to a local agent in India, it would be considered as a seller's commission. You will be including it. Engineering, development, artwork, design, all these expenses are to be added in the valuation only when they are incurred outside India. They may be necessary for the goods, they may not be necessary for the goods, I don't care. In September 25, they mentioned that these were expenses incurred in India and they were necessary for the goods. People got confused that it was necessary, so they added it. No, necessary, unnecessary, I don't care. Only see elsewhere in India or not. If they are incurred outside India, add it. If not, don't add it. In case of air transport, please check the 20% limit, that the total of the local freight, handling charges, and whatever the freight of airport to airport is there, you have to ensure that it does not cross 20% of the adjusted FOB. Point to be noted, the 20% includes the total transport. So it includes the local freight as well. It includes loading, unloading and handling charges also till the point of CIF. I hope you remember our diagram. If you were in our practice batch, we have already given you the diagram, right? See, this is, let's say, the Mumbai port and this is, let's say, the US port. I'm taking a simple example. So here, this point, the price at this point is known as CIF price, and this is what we calculate for the purpose of duty. Whatever expenses are incurred till this point, you have to add it, right? Here the price is FOB. Is it clear? So this is what you have to understand from the field factor point of view, that this is the price we are calculating. Anywhere you feel any confusion that whether something is to be added or not, you remember this diagram, your question will be solved. Yes, let's see some more points. Rule number 4 and rule number 7. Rule number 4 is the identical goods in when we calculate the CVR import rules. If there are more than one price available, you have to pick the lowest value. In rule 7, if there is more than one price available, what is rule 7? Deductive value method. That you have a price available, let's say in market sale in India. From this, you start deducting the expenses and you reach this particular point. If more than one price is available, you have to see whichever is of the greatest aggregate quantity. So for example, there are 100 units sold at rupees, let's say 30, 150 units sold at rupees, let's say 28, and 30 units are sold at, let's say, rupees 10. So greatest aggregate quantity is, you have to focus on the quantity, and this is the price that we'll be picking, rupees 28. I hope this is clear. Certain valuation points to be noted. Ship demurrage charges you have to include because they are incurred at this point of time. Demurrage charges for delay in goods clearance from the airport you have to exclude because these are incurred here at the airport. So after CIF, lighterage charge you have to include, that is the small boat goes and take the goods and comes back to the, that port. So in that case, again, it is incurred here. So you have to include. Transshipment cost came to Mumbai. From Mumbai, they went to another city or state in India. You have to exclude. Payment for right to distribute or resell the imported goods. See whether it is a condition for sale or not. If it is a condition for sale, add. If it is not, don't add. Important note. Now let's see. This is something very, very important. Let's talk from this point of view only. Suppose the insurance charges are not given. So we know we have to take 1.125% of the FOB, and sometimes the question will contain the demurrage charge, let's say the lighterage charge also. So lighterage charge has to be included, but sometimes what mistake you commit, you add the lighterage charge above FOB. And that will be wrong because FOB is the price at this point of time. Lighterage charge is incurred here. Ship demurrage charge is incurred here. So 1.125% of FOB has to be done. And if you add these two expenses in a FOB on which you calculate the 1.125% as the insurance cost, your answer will mess up. Your final answer will not match. So ideally the presentation will work as to FOB, freight, that is the port to port or whatever it may be, and here let's say the lighterage charge, and let's say the ship demurrage charge and insurance. So this insurance will be 1.125% of this value. So you will be adding these. But ensure you are adding after FOB, not before, because your FOB value will get stuck. Is it clear? Now, another thing I want to stress upon, if it is a case of vessel, let's say, the import is happening via port to port vessel mode of transportation. Please understand, very important pointer. And let's say they have not given you the port to port freight, and they have given the local freight and the local handling charges. Let's say this is 10 and this is 20. So what you are going to do, very important question, try to solve a question, your question bank. If you are studying from mine, it is I think question number 22 in my question bank with respect to this chapter of valuation in customs. Otherwise you will be having that question. I think the party name was Jolly. So try to cover that question that I'm trying to tell the point here. Please pay attention now. They have given this 10 and 20. They have not given the port to port expense. What in that case, what would be the freight I would be taking under rule 10.2? I would be taking 20%. But just now I told you this 20% does not only include this freight. It includes the local freight and handling charges also. So what you will be doing, you will be taking this total of 30, you will be making it a part of FOB, and once you calculate 20%, that 20% will be added to all other expenses apart from 30. Because this 30 is deemed to be included in the 20%. See, this point, unless and until you do the question, you're not going to understand, right? Please try to do it. Jolly question. Jolly is the party name, and in my question bank, it is question number 22. Many of you have my question bank, so you can try to do that. Material and component, if it is sent by the buyer free of cost, then you have to include it in the valuation. This is kind of like section 15(2)(b) in GST, that is the obligation paid by the recipient. Chapter number 5, SWS surcharge, that is the social welfare surcharge. Please add it without saying, unless the question explicitly says that please calculate the BCD only. If it is not stated like this, add SWS, and SWS is only applicable in case of import, not in case of export, and the calculation is BCD into 10%. Now certain document filing. Now obviously this was asked in September paper, so I don't think they would be asking this again, but we never know. It's the case of our ICI. So in case of import, one of the primary documents which is to be filed is in case of vehicle, it is an import report that is filed within 12 hours of arrival, and in case of vessel, aircraft, it is IGM, import general manifest or import manifest prior to arrival. Just a point to be noted, I did not cover the dates and rates when of which we have to pick in case of export of goods. So please understand, the BCD rate has to be taken on the date section number 51 let export order is given in case of export, and the rate of exchange CBIC you have to take on the date when the shipping bill is filed. Again, export was asked in your MCQ in September 25 paper, so maybe it is not repeated in this attempt, but still we never know what kind of question they can ask. Let's see. Next, basic filing limit of the bill of entry, very important. What is bill of entry? It is the basic assessment document. So the primary time limit is you have to file it before the end of the day, a day before the arrival, and this will be including the holiday. The board may prescribe, second line you will write, the board may prescribe different time limit, not later than the end of the day of arrival, and advance filing is permitted but not more than 30 days from the expected arrival. Here you will use the word expected, so maybe 1-2 days here there it is possible. Provisional assessment, can we go for it? Section number 18, answer is yes. If ultimately the duty is payable, then in that case there will be an interest applicability, and interest will be from the first day of the month of the provisional assessment. This is very special point to be noted, right? And 15% interest you will be paying. If the amount is to be refunded, here the normal 3 months time limit will apply, that 3 months from the application. No, so not 3 months from the application, 3 months from the finalization of the assessment. And if there is a delay, then you will get the interest at the rate of 6% per annum. So when you are paying it, it is 15% per annum. And when you are receiving it, it is 6% per annum. Point to be noted, I am saying it again, this 3 months calculation is not from the date of the filing of application, but rather from the date of the final assessment itself. Deferred duty, that is the deferred duty rules. It is also known as clear first, pay later. This is not for everyone. This is only for 2 categories of people. AEO program, that is authorized economic operator, importer certified under AEO tier 2 or tier 3, and authorized public undertaking. These both are basically to be approved by the International Directorate of Customs. That point, even if you're not able to remember, at least these 2 points you need to quote. One laptop computer is allowed duty free in India. Yes, that is to every adult. No other condition. No other condition. Only with respect to age, you should be at least 18, and except in case of crew. So crew member is not allowed any import of the laptop duty free. He will get the benefit only when they are they are laid off, like they are laid off from the job, so that is their final return to India. In that case they get all the benefits of the baggage rules, but in general only an adult apart from crew is going to get the benefit of laptop imported duty free. In Annexure 1, you remember Annexure 1, Annexure 2, Annexure 3. Obviously we cannot learn everything, but Annexure 1 you have to learn. So Annexure 1 contains those particular items only when they are exceeding the limit. Now what I'm trying to say here is, let's say for example, the alcohol more than 2 liters is covered under Annexure 1. So up to 2 liters, it is not Annexure 1 and it is allowed to be tested in the GFA limit. So similarly, tobacco 125 grams. So exceeding 125 gram, it will go in the Annexure number 1. But up to 125 gram, you test it under the GFA limit, rule 3, rule 4, where you will be giving the benefit of 50,000 or 15,000 as the case may be. Clear? Yes. So this is something you need to make a note of. Cigarettes, cigars, so 125 cigars, all those limits you need to pay attention to. One specific item I want to cover from Annexure number 2 and Annexure number 3 is domestic refrigerator. If the capacity is up to 300 liter, it is a part of Annexure 3. And what I feel the question can be asked is, if it is a part of Annexure 3, it can be used for the benefit of rule number 6, that is transfer of residence. 60,000, 1 lakh, 2 lakh, 5 lakh, depending upon how much time you have stayed abroad. So in that case, this can be allowed. If the refrigerator limit capacity is more than 300 liter, it will not be under Annexure number 3. So we will not get the benefit of rule number 6. Infant, when the infant is also coming into India, you get the benefit that only and only the duty-free import allowed for an infant is used personal effects, nothing else, right? But what do you mean by infant? Infant means up to 2 years of age. And secondly, infant should be traveling with you. I am traveling alone. I have got some used personal effects of my child. Let's say he's an infant. So in that case, I'm not going to get the benefit of that duty-free import of used personal effect, because infant is not traveling. Passenger needs to be in the infant. Okay. So in this case, it will be tested against my GFA limit. Another some mistake areas are jewelry. It is not considered as a personal effect. Day-to-day necessity, no, it is not allowed. You test rule number 5 for that. Jewelry allowance you test, and if the rule number 5 is exhausted or it is not applicable, can we apply the GFA limit for jewelry? Answer is yes, you can apply. Rule 3, 4 you can apply for the jewelry as well. Okay, so these were certain points. If anyone is coming from Nepal, Bhutan, Myanmar, by land, only use personal effects are allowed. Nothing else. Nothing else is allowed. The limit of 15,000 and obviously the travel souvenirs and everything that will be applicable only when coming by vessel or air. Jewelry allowance, I have told you, more than 1 year they have stayed. So in that case, you will get the rule number 5 allowance. Next is section number 48, that is the disposal of goods not cleared. So if the goods are relinquished, that is abandoned, or they are not cleared within 30 days, then what happens is a public auction is held, and except in case of arms and ammunition where there is a private sale. But yeah, the public auction is held and the goods are cleared and they are sold it to the highest bidder, right? So in this particular case, the bill of entry is filed by the custodian. Normally it is filed by the importer, but here there is no importer. Here there is the successful bidder. So the consolidated bill of entry buyer-wise is filed by the custodian. This is something you need to make a note of. In case of postal or courier article procedure, this is a part which is sometimes overlooked. So I'm just repeating certain dates you have to pick because this can be asked in the MCQ as well. In case of import, which date you have to pick for the rate of duty and tariff valuation. If it is a case of air or land mode of transportation, then you have to see whenever the postal authorities or the courier authorities is handing over the list to the PO for the purpose of assessment of duty. If it is a case of vessel, you have to compare that date when the PO is basically when the list is handed over to the PO and compare it with the arrival of vessel. Here they have not picked the entry inwards date, arrival of the vessel, and whichever is later. If it is a case of export, then you have to see here there is no involvement of the PO. You have to see when you as an exporter are handing over the goods to the postal or courier authorities for the purpose of exportation. In case of supply as stores, again stores is a very specific topic. Not many people do it, but at least something I want to stress upon here, that there is a benefit where you get the duty drawback with respect to the items which are supplied as stores as well. What is duty drawback? You imported the goods, you paid the duty, and now you're supplying it as a stores. So can I get the duty drawback benefit? Although that is not in our course in detail, but you need to just have a basic understanding that if the goods are exported, these goods were actually imported, I paid the duty, and now they are exported within 2 years, I get 98% of the refund as duty drawback. That same benefit I will get here also when they are supplied as stores. Okay, now what is the point to be noted here? Why I have picked it in this particular the HOTS section is in two cases. That is, if you are supplying the fuel lubricants on a foreign going aircraft, instead of 90% you are going to get the 100% as a drawback, and in case of ship stores supplied to Indian naval vessel, you will get again 100% of the drawback instead of 98%. These 2 points you need to make a note of. Okay, next, basic import flow. This was asked in the individual ICI MCQs that is available on your BOS site. So basic import flow and the procedure is first IGM is filed, then comes entry inward in case of a vessel, then unloading happens, then you file the assessment related document bill of entry on which assessment happens, and then there is a final duty payment. This was asked in one of the MCQs that you have to select the correct procedure of the order. Okay, export flow, shipping bill or bill of the bill of export, then ensuring that the goods are not prohibited and the duty is paid, clearance and loading order, then the goods will be loaded, then you deliver the EGM to the PO, and final let export order, that is the order to leave, right? Next, chapter 6, warehousing. Warehousing period. Now obviously there is a bifurcation that where the goods manufacturing is allowed, section 65, or where the manufacturing is not allowed. If the manufacturing is allowed, essentially there is no time period. In case of capital goods, you can keep it till X bonding. In case of raw material, you can keep it till X bonding or consumption. But where the warehousing is not permitted, the time limit is 1 year. 1 year from the order permitting the goods into the warehouse, that is section 60 order. And obviously you can get an extension 1 year at a time by the commissioner. But interest period. Interest starts from the expiry of the 90 days. You may get the permission of 5 months or 1 year or whatever it may be, but the interest will start from the expiry of the 90 days. And obviously when we say the 90 days period, you have to start counting it from the day after the date. Basically, you have to start counting it from the date after the date of the PO's order, because that is how the ICI does it. You remember this typical point, right? You must have solved it in the questions. Section number 65, that is where the manufacturing is permitted. It is not allowed in a public bonded warehouse. It is allowed in a private or a specially bonded warehouse. In refund, just a point that interest on refund that you get, that is only on the duty portion, not with respect to any deposit or any other amount. 26 and 26A, these are basically the refund of the export duty and import duty. Here the special time limit, it is not 1 year. The application needs to go within 6 months. Specifically in 26A, I will just give you a brief that the goods are imported and there is some problem, these goods are defective. So what happens to the goods? Either you render them commercially valueless, you destroy them, or you export it back, or you abandon them. So whatever step you are taking, that you have to take within 30 days of clearance. So whatever step you are taking, either you are destroying the goods or whatever it may be, you do that step, you take that step within 30 days. And whenever you are taking, let's say I took the step here, within next 6 months, you will file the application for refund. These were the points. Now there is certain bonus points, some more points I was able to put it from the question answer solving. So let's see. If there is an intrastate supply, but it is some other state. So for example, classic question they ask is for the hotel industry. I am registered in Pune, Maharashtra. I go and stay in a hotel in Delhi. So that will be a Delhi intrastate supply. I in Maharashtra will not be able to take the credit of that. Another example, I am registered in Maharashtra. Let's say I go and buy goods in Gujarat on as is varies basis. What do you mean by as is varies basis? It means there is no movement of the goods. The goods are there and you are just buying it. So here again, the supplier is in Gujarat. The place of supply will be in Gujarat. 10(1)(c) case. So here also I will not be able to get the credit. Brother, sister, they will mention that casually, very casually, that brother is owning a factory or your sister is, a well-known consultant. What does it imply? It implies that they are not dependent on you. So they are not a part of family. If they are not a part of family, they are not your related person. If any transaction happens with them, you don't need to go to the valuation rules. The transaction value will be accepted. Section number 15. Okay. Next. One particular example, if the goods are imported, let's say on 28th of December, but they reach the business premises on 3rd January, you will take the credit in January for the January month because the goods are received in January. Here there is a concept of intentional lot versus unintentional lot. This is a term that we are using it. This is not in by the ICA. Just understand what is the point to be noted. If a particular consignment of goods is sent in lots, so for example, 10 lots are coming in. Here it is very clear that ITC will be available when the last lot is received. Yes, when the last lot is received. But this is a case of intentional lot. This is clear. Sometimes the goods are not sent in lots. They are sent as a whole only. But one particular part of the goods is received late due to, let's say, some riots in the area or there was some problem. So only the ITC with respect to that part of goods I will receive when they are, I will be able to claim the ITC when though that particular part is received, but the balance I will be able to get the credit when that original part is received. I will just give you a small example. Let's say they are mentioning that rupees 1 lakh goods were sent in the month of June. Let's say goods worth rupees 20,000 were received in July due to some riots in the area. So 20,000 ITC, whatever it may be, I will receive in July, but balance 80,000, I will be able to claim it in the June. So this is unintentional lot and this was intentional lot. Okay, so here entire ITC I will get when the last lot is received. This was just a small point to be noted. FSSAI, that is the Food Registration Authority. This point to be noted. Tax will be applicable here. This is not exempt and it is chargeable under FCM basis. This is on the basis of the ICA case booklet point. Check if the question is asking the answers for total of the CGST, SGST or only the CGST part. Governmental authority and governmental entity. These are the two terms that you need to make sure of that you know it well in the exemptions chapter. Governmental authority, governmental entity, minimum 90% equity control is of the government here. Okay. In September 25, they had mentioned that it was 85% control. So here, technically they were not governmental authority entity and exemptions were not going to apply, but many students missed out on that part. Just on a related note, section number 51 TDS also we use the word authority board government related, but there the control is 51%, not 90%, right? These were the points from my side for you guys. This was a complete 100% English video. I had to record it again for you. So that's why there was some delay and I didn't want to give you a dubbed version. So I really hope this was useful. If possible, do comment your feedback. It helps us to reach more students. And yeah, that is all from my side. I really hope you learned something new. All the very best for your preparation. Do well. Bye-bye.